a recess of the committee at any time. The hearing is for the purpose of receiving the annual report of the Financial Stability Oversight Council, which will be presented by the Honorable Jack Lew, Secretary of Treasury and Chairman of the Financial Stability Oversight Council. I now recognize myself for 5 minutes to give an opening statement. Again this morning, we welcome back Secretary Lew to discuss FSOC, but before we do discuss FSOC, I would be remiss if I did not bring up the continuing scandal at the Internal Revenue Service, an agency that is part of Treasury. Mr. Secretary, 13 months ago, you appeared before us and said, quote, "My highest priority is to restore confidence in the IRS," unquote. I think we know, Mr. Secretary, both of us, that that has not yet occurred. Back then, President Obama said of the IRS scandal, quote, "The misconduct is inexcusable and Americans are right to be angry about it, and I'm angry about it." He said his administration would cooperate with Congress to uncover the truth. That's what he has said. Regrettably, that is not what has happened. In just the last few days, we've learned the administration has known since at least February that years worth of IRS emails of 8 IRS employees at the epicenter of the scandal have simply vanished. How terribly convenient for the administration, but how inconvenient for the American people who expect equal protection under the law. The American people, regrettably, but understandably, are becoming increasingly cynical and fearful of their government. There's a growing resentment of one set of rules for Washington and another set of rules for everyone else. In other words, no one believes that simply saying, quote, "Sorry, I've lost my emails," is an excuse the IRS would accept from a taxpayer being put through a torturous audit. Mr. Secretary, I trust you agree the American people deserve better, and it's past time for openness and transparency from this administration on what you told this committee 13 months ago was your highest priority. It is also past time for openness and transparency at FSOC, which you chair, Mr. Secretary. While you and other administration officials habitually cite the purported dangers of financial stability posed by the shadow banking system, you ignore those presented by the shadow regulatory system of which FSOC is front and center. Indeed, with the exception of agencies dealing in classified information related to national security, FSOC may very well be the nation's least transparent federal entity. The public cannot view their proceedings because 2/3 of them are conducted in private executive sessions. And when the minutes are produced, on average, they weigh in at a mere 5 pages long, with half the pages devoted to memorializing attendees' names and resolutions considered. Better Markets, a public interest group that consistently advocates for more regulation of our financial sector, has stated, quote, "The FSOC's proceedings make the Politburo look open by comparison. No one in America even knows who they are. At the few open meetings they have, they snap their fingers and it's over, and they are all scripted. They treat their information as it were state secrets," unquote. To begin to remedy this sad situation is one of the reasons this committee has ordered H.R. 4337, the FSOC Transparency and Accountability Act, favorably reported to the House. The reason transparency and accountability are so important is because FSOC can designate practically any large financial firm in our nation as a systemically important financial institution, a SIFI, and thus render effective control over it. Thus, it has the ability to render great damage to our economy and set back the dreams of tens of millions of our unemployed and underemployed Americans who are counting on their capital markets to work for them. Recently, Douglas Holtz-Eakin, the former director of the CBO, has estimated that designating asset managers as SIFIs could cost investors as much as 25% of the return on their investments over the long term, or approximately $108,000 per investor. In other words, as it operates in the shadows, FSOC can take away the seed capital necessary to launch a small business or to send a child to college. That is both unfair and unwise. And while FSOC seems dead set on trying to find systemic risk where no one else seems to find it, a review of their latest report indicates it is willfully blind to the largest sources of systemic risk. Hardly a mention of Fannie Mae or Freddie Mac, who are at the epicenter of the last financial crisis And without the leadership of the administration to end permanent taxpayer subsidies, they are certain to be at the center of the next financial crisis. No mention of the federal government itself, $17 trillion in debt and growing, more debt incurred under this administration than our nation's first 200 years. Our offices are all awash with CBO and independent reports saying the pace of spending is unsustainable, but rather than rein in government spending or prioritize interest payments on the debt, the administration regrettably turns a blind eye and has threatened to even allow default on our sovereign debt. So this committee has also passed H.R. 4881 to place a one-year moratorium on further designations of non-bank SIFIs. Again, Mr. Secretary, I would call on FSOC to cease and desist with these designations so Congress can have time to conduct effective oversight and get answers to questions that both Republicans and Democrats have raised about FSOC's decision-making process. I now recognize the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. Today, I'm very pleased that you're here, Secretary Lew, and I welcome you back. And I assure you that we are not poised here today to talk about the IRS that's been done over in oversight investigations. We don't have documents, we don't have emails, we don't have any information relative to that issue. We gather here today to receive your annual report of the Financial Stability Oversight, that is FSOC, as required by the Dodd-Frank Act. To be honest, I'm surprised to see so many of my colleagues on the other side of the aisle with us today, given that the FSOC has joined the ranks of the Consumer Financial Protection Bureau, the Export-Import Bank, and the Terrorism Risk Insurance Act in becoming the latest target in a relentless Republican effort to tear down important engines of job creation, economic growth, and consumer protection. I didn't think my colleagues on the other side of the aisle would have any interest in hearing about the Council's progress or in your views of the financial stability of the United States. In fact, just last week, this committee approved two measures that, under the guise of transparency, would compromise the FSOC and erode the important role it plays. These partisan bills were nothing more than an effort to derail this cornerstone of the Dodd-Frank Wall Street Reform Act. Mr. Chairman, the economic collapse of 2008 resulted in the greatest loss of wealth in a generation. Starting with the bankruptcy of Lehman Brothers, our economy quickly ground to a halt, leaving the American taxpayers to clean up the mess. All told, the financial crisis resulted in the destruction of more than $9 trillion in wealth and cost each American household approximately $50,000, while unemployment exploded throughout the country. One problem leading up to the crisis was that no one in the private sector or in government saw the big picture or had the responsibility to deal with emerging threats before they caused damage to our economy. That is why Democrats created the Financial Stability Oversight Council, that is FSOC, to fill that void and serve as an advanced warning system to identify and address systemic risks posed by large, complex companies, products, and activities before they threaten the economy. In plain English, FSOC is charged with looking at every aspect of our financial system for possible weaknesses and risks, something that did not happen in the lead up to the crisis. The Council's work is critical to ensuring that our financial regulators are working collaboratively to identify and respond to emerging threats to financial stability. It remains a mystery to me why Republicans are spending the few legislative days we have left in this session pushing partisan legislation that would hamstring the FSOC's ability to protect homeowners, consumers, and the American economy. And it's obvious that, like with CFPB, XM, and TRIA, the Republicans' goal is to stop the program from its important work, even if that means ending important protections for the American people and our economy. Secretary Lew, I look forward to your insight on areas of systemic risk the Council has identified, particularly related to mortgage servicing, alternatives to reference rates like LIBOR, and perceptions of too big to fail. As we hear additional details from you about the risk identified in this year's report, I will be interested to hear whether Republicans believe FSOC should take action to mitigate those risks or turn a blind eye and invite another crisis. Finally, Mr. Chairman, I'm looking forward to hearing more from you about how we address concerns that I and other members of Congress have raised regarding the transparency of the FSOC designation process. I'm sympathetic to these concerns and would like to hear what steps you have taken and your suggestions on how to increase transparency in a way that continues to carry out FSOC's mission. I look forward to the Secretary's testimony and his insight on all of these issues, as well as what the FSOC is currently doing to monitor systemic risk and promote financial stability. I yield back the balance of my time.
Chair now recognizes the gentlelady from West Virginia, Ms. Capito, Chair of the Financial Institutions Consumer Credit Subcommittee, for 1 minute.
Thank you, Mr. Chairman, and thank you, Secretary Lew, for being with us today. We're going to learn more about the FSOC, which was created by Dodd-Frank as the mission of monitoring systemic risk. This designation can have a significant effect on the institution by requiring increased levels of regulatory capital. The costs associated with heightened prudential standards are quite clear. However, the processes and methodologies for determining a non-bank firm's systemic risk are much less clear. In fact, in the recent designation of Prudential Insurance, the one member of the FSOC with significant insurance industry experience argued that there was little evidence to support the notion that a large life insurer poses a systemic risk. Furthermore, we know little about how an institution's designation will affect the end users. Another issue I'd like to discuss with you, Mr. Secretary, are the arbitrary thresholds in Dodd-Frank that determine if a financial institution is systemically significant. There's been a lot of discussion about the different thresholds, and I'd like to dig deeper with that with you. Thank you.
Time of the gentlelady has expired. The Chair now recognizes the gentlelady from New York, Ms. Maloney, Ranking Member of the Capital Markets Subcommittee, for 1.5 minutes.
Thank you, Mr. Chairman, Ranking Members, and welcome to Secretary Lew. I believe I speak on behalf of all New Yorkers when we say we are so proud of you and your many years of public service. This is an important hearing. The Financial Stability Oversight Council was one of the keys of the Dodd-Frank financial reform, and it provides a forum for all of our financial regulators to come together to discuss the risks that they each see in the markets they regulate, but from a broad perspective, from a systemic perspective. It also requires them to publish an annual report that describes in detail the emerging threats that they see in the financial markets, and this is tremendously important. It depends on what report you look at. The ranking member said $9 trillion. I've seen some reports that said that we suffered $16, $18 trillion in loss to our economy. Christina Rummer testified before this Congress that the economic shocks we experienced in the last recession was 3 times greater than the Great Depression, and we managed it better. But also economists have testified before this panel and other panels that it was the only financial crisis in our history that could have been prevented by better financial market overview and regulation. We didn't keep up with the new products. We didn't keep up with the new trends. So FSOC was created to help us prevent another serious, damaging, painful economic loss that we could have prevented with better financial management. I look forward to reading your report. Thank you.
Time of the gentlelady has expired. The Chair now recognizes the gentleman from New Jersey, Mr. Garrett, Chairman of our Capital Markets Subcommittee, for 2 minutes.
Thank you, Mr. Chairman. Today, FSOC has become a sort of super regulator whose SIFI designation is effectively an implicit taxpayer guarantee. Over time, I believe too big to fail SIFIs will use their capital cost advantage to drive smaller competitors out of business. In short, FSOC now picks the winners and the losers in our financial markets. As FSOC aggressively asserts itself over more and more sectors of our economy, insurance companies and asset managers most recently, they owe the American people an explanation for what they're doing. Despite the 147-page FSOC recently released report, the vast majority of which is a rehash of basic economic information available on any financial website, FSOC's decision-making process remains a black box. Citizens whose livelihood are directly affected by FSOC have little idea why FSOC makes the decisions it does. And you know, as Congressman, I can be briefed on the most sensitive intelligence and national security information, but I'm not allowed to even sit quietly and listen in on an FSOC meeting. And companies that are designated by FSOC have only the vaguest notion what aspects of their operation led FSOC to deem them systemically important. So without that knowledge, of course, they can do nothing to reduce their own systemic risk. And more importantly, when Republican members have asked questions of you and of FSOC in the past, the answers we received have always been bland and evasive talking points designed simply to give us the impression of responsiveness without actually ever answering any of our questions, Mr. Secretary. In fact, this committee asked you specifically last month for all the documents and all the communications between you, your department, and FSB. And I have everything that you supplied us with right here in this box in response to your promise to supply us with all of those documents. We got absolutely nothing from you when you promised us that you would supply us with that information. Mr. Secretary, this stonewalling by you and this department must stop. We have to get real answers from you and from Treasury, and I hope that today the process begins. Mr.
Time of the gentleman has expired. The chair now recognizes the gentleman from Colorado, Mr. Perlmutter, for a minute and a half.
Thanks, Mr. Chair, and Mr. Secretary, it's good to see you here. I want to thank you. I want to thank the administration. Since the President took over, since Dodd-Frank was passed, the stock market is up 10,000 points at about $1.3 billion per point. My math takes that to $13 trillion. Home prices are up. IRAs are up. And we've put 10 million people back to work. And I just want to thank you for that. We had kind of an age-old debate a few weeks ago. Mr. Scalia was here saying that Dodd-Frank and FSOC had too much discretion. We had members of the banking community saying there was too little discretion and too arbitrary lines of demarcation within the bill. I have two areas I'd like you to talk about today. One is the living wills, what you're doing on the major institutions to find out if they fall apart, how you're going to take them apart. And secondly, I want you to talk a little bit about the GSEs. I am one of those who thinks that with proper underwriting, the GSEs actually work very well, and the private market will come and go as they think they can make money in mortgages. And now there isn't a lot that has to be done with respect to the GSEs. So I'd like you to talk about living wills and GSEs. And with that, I thank the chairman and I yield back.
Gentleman yields back the balance of his time today. We welcome the testimony of the Honorable Jack Lew, Secretary of the Department of Treasury. Secretary Lew has testified before our committee on a number of occasions, so I trust he needs no further introduction. Without objection, Secretary Lew's written statement will be included in the record. Mr. Secretary, you are now recognized for your oral presentation. Thank you.
Thank you very much, Mr. Chairman. Chairman Hensarling, Ranking Member
You got to
Waters.
speak into the mic a little more.
Yeah, Mr. Secretary, if you could pull that a little closer, please.
Can you hear me now?
Yes, much better. Thank you.
Chairman Hensarling, Ranking Member Waters, members of the committee, thank you for the opportunity to testify today on the Financial Stability Oversight Council 2014 annual report. Nearly 4 years ago, President Obama signed into law the Dodd-Frank Wall Street Reform and Consumer Protection Act, creating the strongest safeguards for consumers and investors since the aftermath of the Great Depression. As everyone here recognizes, a stable, thriving financial sector is critical to our economic growth and prosperity, and that's why these historic safeguards were established. Today, our financial system is more resilient, confidence in our markets is robust, and the agencies charged with protecting consumers and investors are in a strong position to respond to emerging threats that could hurt our economy, damage Main Street businesses, and destroy jobs. One of the lessons from the financial crisis was recognizing how important it is to detect and mitigate risks to financial stability. In the lead-up to the crisis, individual regulators focused on individual institutions, functions, or markets. The siloed approach allowed risks to fall through the cracks. Congress changed that by creating the Financial Stability Oversight Council. Now regulators are obligated by statute to collectively monitor the stability of the entire U.S. financial system, to look over the horizon, to identify potential risks, and to respond to threats that have been detected. In short, the Council's work to detect possible risk is not only mandated by law, it is sound economic policy. That's why it both defies common sense and ignores recent history that some have suggested curtailing the Council's ability to analyze information regarding particular financial sectors, firms, or activities. The Council cannot simply cordon off any sector or activity that could pose a threat. That would be a dereliction of its responsibilities and a complete disregard for the very purpose of the Council. Some have even gone so far as to suggest the Council should be prohibited from simply asking questions about certain activities or companies that could threaten financial stability. We have to be allowed to ask questions. As everyone here knows, during the run-up to the financial crisis, regulators should have asked more questions about institutions and activities, not fewer. To be clear, asking questions does not equal regulatory action. Sometimes questions result in a conclusion that the Council does not need to act, that it needs to examine the issue further, or that it needs to gather more information. The Council asks questions with an open mind and without a predetermined outcome. In that vein, the Council's procedures are transparent. It has put in place a comprehensive, deliberative approach to its evaluation of risks, and it solicits public input and carefully considers all points of view. In fact, the Council's annual report exemplifies the Council's commitment to transparency and collaboration. It reflects the collective analysis and conclusions of Council members regarding the key risks to financial stability and is an important example of how the Council shares information about its work with Congress and the public. Each annual report also provides a roadmap for the Council's agenda for the upcoming year, what areas it will focus on, what areas will likely require additional attention, and how the Council expects to address them. This year's report focuses on 9 areas that warrant continued attention and possibly further action from its members. These areas include wholesale funding markets, the housing finance system, cybersecurity threats, risk-taking by large financial institutions, and potential interest rate volatility. Before closing, let me point out that since the Council's last annual report, we've reached a number of key milestones in financial reform implementation. That means that homebuyers, retirees, and investors have better safeguards and protections. To that end, the Volcker Rule has been finalized, qualified mortgage standards have gone into effect, tough capital standards are now in place, over-the-counter derivatives are now moving onto electronic trading platforms and into centralized clearing. Fines have been imposed on abusive actions related to manipulation of LIBOR and other financial benchmarks, and the international community is making progress on increasing the stability of the global financial system. Mr. Chairman, I want to thank members of the Council and all the staff involved with the 2014 annual report for their tireless work and commitment. As the Council fulfills its obligations to strengthen our financial system and limit risk to our economy, we will continue to work with you, the Committee, and Congress to make real progress for all Americans. Thank you, and I look forward to answering your questions.
Chair now recognizes himself for 5 minutes for questions. Mr. Secretary, I'd like to start off with a matter that I left off during your last appearance, for which I did not receive an answer. It's not a gotcha question, and when I receive the answer, I'll certainly be fair and give you a brief moment to give it some context. As you well know, 11 months ago, the G20's FSB, of which Treasury is a plenary member, designated 3 U.S. insurers as global SIFIs. Did Treasury support these designations, yes or no?
Mr. Chairman, as I mentioned the last time I testified, the FSB operates by consensus, and the U.S. participants in the FSB joined in the consensus at that time.
Okay, so Treasury consented in the designation, correct?
We joined in the consensus. There was not a vote, but we were part of the consensus. But I need to really make the point quite clearly that action in the FSB and action in the FSOC are very different matters. The FSB is not a national authority. It doesn't designate institutions in a way that has legal effect. And the FSOC, when it makes its determination, does it on a parallel path. It may ask and answer questions in a similar way, but
then let me ask this question, Mr. Secretary. Can a financial institution pose, in your mind, a systemic risk to the global economy without representing a systemic risk to our domestic economy?
Mr. Chairman, I think the question of designation is a moment in time and based on analysis at hand at that time. In the case of a designation of a specific institution, the process at FSOC goes through a very detailed
I understand there may be two different processes, but I'm simply asking is, in Treasury's opinion, if one is a threat, a potential systemic threat to the global economy, must they necessarily also be a systemic risk, present a systemic risk to the domestic economy?
And the reason I'm answering your question the way I am is that in making a determination at the FSB level, it's based on the information and the analysis you have at that point. That what you go through an FSOC determination process is a very detailed exchange of information ultimately with a company.
So are you simply telling me that two different processes may lead to two different answers?
They could.
So Treasury then, you're telling me, could support a designation of the exact same firm as systemically risky to the global economy, but not be systemically risky to the domestic economy.
The action taken in the FSB does not designate a company in the same way that FSOC does. So it's the only national authority that can designate a company for regulation.
I'll tell you what, Mr. Secretary, my time is limited. Let me move on. I think you know that Bloomberg, different subject, Bloomberg reported that when the chairman of the SEC told the FSOC that they wanted to release the Office of Financial Research Asset Management Study, which, as you well know, has been widely panned, Bloomberg reported that you personally called the SEC chair, quote, to express your displeasure, unquote. Is that story accurate?
Well, I'm not going to get into the details of private conversations that I may have had with other members of the FSOC.
Okay, then let me ask the question this way. Did you favor or oppose releasing the study to the public?
Look, my view was that the OFR study was going to be released to the public, and the public was going to be commenting on it. The question of whether or not it would be released in any kind of a formal way asking for comments by an agency other than OFR is a different question.
Should OFR's
there's never
work,
a question that the OFR study would be public.
should the OFR's work be immune from public comment?
No, on the contrary. The OFR report was meant to be public, and it was meant to elicit a public debate, and that debate occurred. So I very much believe that it should have been public. It was public. And the only question was, should it be formally put out by one or another agency for comment in a formal way?
Last year you said, quote, it is unacceptable to be in a place where too big to fail has not been ended. If we get to the end of this year and we cannot, with an honest, straight face, say that we have ended too big to fail, we are going to have to look at other options. I think you may know a few months ago, your predecessor, Secretary Geithner, was asked if too big to fail still exists. His answer, quote, yeah, of course it does, unquote. Using your words, can you tell this committee today with an honest, straight face that we have ended too big to fail?
Yeah, Mr. Chairman, we've made enormous progress. I'm not sure we'll know the answer to that question until we have the next financial crisis. That's the challenge that we all have in asking, have we gone far enough? But I will say that there's more work underway to continue to look at the areas where we could have more protection, things like supplemental capital.
We have heard from multiple witnesses that the Volcker rule will significantly reduce liquidity in the corporate bond market. The Financial Times has reported that the Federal Reserve is very concerned about the potential of large-scale withdrawals from investors and managers of corporate bonds. They are concerned about the illiquidity of the corporate bond market. So it strikes me as somewhat ironic that the Volcker rule, which has been touted by you and others as necessary to ensure financial stability, may now be a part of financial instability. This committee has requested information from Treasury and FSOC regarding the status of our corporate bond markets. We haven't received anything as yet. So has the FSOC conducted an analysis of the systemic risks that could result from a lack of liquidity in the corporate bond market?
Mr. Chairman, we obviously are just in the early months after the final publication of a Volcker rule that is final. It hasn't taken effect in the marketplace yet, so it's premature to judge what its impact on the market is. I think it's actually quite an accomplishment that 5 independent regulators published an identical rule on the same day, providing clarity in an area that badly needed clarity so that there would not be uncertainty in the industry. I've actually received quite a lot of positive comment that that was the result.
The time of the chairman has expired. The chair now recognizes the ranking member for 5 minutes.
Thank you very much. Some have criticized the FSOC's designation process as being opaque. The GAO also made several recommendations to the FSOC to improve its transparency. Would you please describe how the FSOC has addressed these recommendations? Would you also describe how the FSOC changed its transparency policy last month? Is the FSOC appropriately balancing the need for transparency against the need to protect sensitive market and supervisory information? This is an issue I'd like to get behind us and deal with it in ways that would allow FSOC to do its work. And so I'm hoping that you have not only given considerable thought to this, but to help us to understand how we can better make sure that you can carry out your mission and not have those that you are regulating and giving oversight to believe that somehow you're trying to do all this in secret. And I don't want to spend all of my time on this because I really do want to get to non-bank mortgage servicing. So would you please respond to the first part of the question?
Congresswoman Waters, I think that the values of openness and transparency are very important to all of us. We have constructed a process in FSOC which I believe respects and reflects those values. And it gives an enormous opportunity for companies through the designation process to engage with FSOC without making public prematurely things that would not be appropriate to be a public discussion. Much of the discussion in a designation process involves reviewing the internal information that is the kind of supervisory information that regulators work with. When we get to the final stage of the designation process, there's a back and forth that is quite voluminous with the company, where the company is sharing proprietary information that gets to the essence of their business. So I think what we need to balance is what is a process that requires a certain amount of confidentiality with transparency. We just recently made some changes, and it's a young organization. It's continuing to evolve, where we are noticing in advance topics to be discussed. We're putting out minutes of meetings, notes from meetings afterwards. And, we will continue to try to perfect the process. But I don't think the answer is to say it should all be a completely open public discussion, or the inquiry itself would be stymied.
Mr. Secretary, I'd like to ask you to make sure that the staff of FSOC gets with the staff of this committee, and I would hope that the chairman would agree, so that you could walk through whatever changes you have made in order to have more transparency. We need to understand that because, as you know, with H.R. 4387, this bill would subject FSOC to the Sunshine Act, expand its membership, and change voting protocols for commission and board members, and allow members of Congress to attend and participate in FSOC closed-door meetings. Now, I think this is ridiculous, and I want to get off of that. And so if you will help us to understand more what you have done, then hopefully we can engage with you about what we think about what you have done and maybe have some suggestions for you. With that, do you have a moment to talk about what you have done, taking a look at non-bank mortgage servicers?
So the question of mortgage services is a very important one. As they've moved out of banks into more independent businesses, the challenge is how to maintain consumer protections and oversight, and how to make sure that that very important backbone to our mortgage finance system functions well. I think if you look at the actions taken by the CFPB, they have taken on the role of consumer protection oversight in a very important way. And I think that it is an area that we have to continue to look at, understand, and if we need to take more action, discuss what that is. Obviously, the mortgage system requires that there are servicers who are reliable, who are there to handle the transactions between the borrower and the holder of the mortgage. and it is something that we cannot have be fragile. So it's something we're very much watching, and we think that the actions taken by the CFPB are very positive ones, and we will continue to review the situation.
Mr. Secretary, let me just say, one of the things we discovered with the subprime meltdown was a lot of the problems were with the servicers. The loss of paper, the lack of understanding, what their jobs really were, the inability to make determinations about whether or not people had sufficient income to meet a proposed modification, on and on and on. So this is a serious area that
Very
needs
important
to be addressed.
area. Totally agree.
Thank you, and I yield back the balance of my time.
Chair now recognizes the gentleman from New Jersey, Mr. Garrett, Chairman of the Capital Markets Subcommittee.
Thanks. So, Mr. Secretary, as you know, the Chairman, some other members of this panel, and myself have asked for specific documents from you, and we did so over a month ago, and you assured us that you would provide them. You formally responded only last Friday, and you did so with a non-response. The response contained none of the requested documents. Mr. Secretary, this committee has to subpoena those documents. Can you promise us here today that any emails that make up those documents or files that we have requested will not fall victim to any mysterious or unexplained hard drive crash? And are you doing anything now to protect those documents that we have requested and you promised that you would supply, but after a month you still have not done so?
Congressman, as you noted, I did respond along with the chairman of the SEC and the chairman of the Federal Reserve Board to your inquiry. In that letter, we said our staff would work together.
So will you protect those documents because you did not provide any documents that we requested?
And as the letter indicates, our staff will work with your staff on...
Are you protecting those documents?
We routinely protect our documents.
Well, we know the routines over the IRS. Is it a better routine than they have?
Congressman, we have...
okay, that's a no.
No,
Mr. Chairman, I would,
Mr.
Chairman,
No.
I would suggest that we consider
we protect
issuing...
our documents and we'll continue the conversation.
I would suggest that we consider issuing the subpoenas sooner rather than later, given how fast emails are disappearing within the Treasury Department. I have a question from you from home. This is a little bit off topic, but if the IRS is conducting an audit of a law-abiding taxpayer or citizens, I get this a lot over the last several weeks, and the IRS asks for documents and they do not come, and they say that they don't have them from anymore because their hard drive crashed. The IRS, and your response to them would be, that's okay because that's with the routine system?
Congressman, as Commissioner Koskinen testified last week, if that happens to a taxpayer, the practice is for the IRS to work with the taxpayer based on documents that are available to proceed.
So I'll take that as, and so we are going to be working with you, and that's why I suggested that we issue subpoenas now, because you have not supplied that information that you have promised to this committee. Mr. Chairman, I don't have any confidence in this administration to be able to conduct a fair, impartial, and thorough investigation into that matter, nor to supply the information that this committee has requested repeatedly. And for that reason, I do believe that a special prosecutor should be appointed to find the truth as to what actually happened there, and for us to go forward as quickly as possible with regard to subpoenas. Now, to return to the matter at hand on FSOC and designations, the Chairman asked you a very simple question with regard to consensus. I think most people watching understand what consensus means. It means that the parties at a table consent to something. That's the root word of consensus. So FSB, in that process, said there was a consensus on the matter, and his simple question was, did you consent? And you did not give an answer. Can you say whether, when they went around the table figuratively, did you consent? Did you say yes, no, or I really don't know what to answer?
Congressman, I answered the question. I said the U.S. government representatives joined in the consensus.
So you said yes.
I answered the question.
No. And so when you made that determination, the Chairman also asked the question, is it possible for a company to be globally designated but not to be designated by nationally by a SIFI? And the answer to that one is also yes?
Yes, I said that there are parallel processes, and the FSOC, which is the national authority, would make its own determination based on the process conducted at FSOC.
So a company could be globally important in the SIFI, but not here in the United States. How is that possible?
The process of the FSB designation is one that is not binding on national authorities. Obviously, it is.
It's not a matter of binding. It's
Yeah.
whether or not that company is actually systemically important on a global basis.
That's the reason that the FSOC goes through a very detailed analysis. There's more information.
So does that mean that the FSB process is not a detailed analysis?
No, I'm not saying it's not a detailed analysis, and I'm not saying that the outcome would be different. I'm just saying that there is a parallel national process that takes place.
So in a legal matter, when when a judge has made a decision in one case, it oftentimes has to recuse itself when the same parties are involved in that, or the same issues come up. That lawyers have to do that all the time. Will you recuse yourself from that deliberation process when these same companies come up for designation on the SIFI basis, even though they are different processes?
Congressman, the responsibilities that all of us on FSOC have is to review all of the information and make a decision based on the information presented in the FSOC process, which is what I will do.
So the answer to that is no.
I will do my job reviewing all the documents and all the analysis, and we will make a decision based on that.
Time of the gentleman has expired. The chair now recognizes the gentleman from Massachusetts, Mr. Capuano, ranking member of the Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. Mr. Secretary, I'm tempted to talk about the batting averages of the Red Sox, but I think I'll wait for another day for that. And that's my biggest concern right now, to be perfectly honest with you. I do want to talk about a couple of concerns. First of all, I want to thank you for the job you've done. I think you've done a great job. But like everything else, there's details that have to be worked out. And I have a lot of constituents who are concerned about questions that have not happened yet. I'm very happy with what FSOC has done, but I have my concerns about some of the things that have not yet. The second shoe hasn't dropped. And I want to talk to him a minute about the International Association of Insurance Supervisors, of which you're participating, and I got a response from you to a letter we had written. And I want to read a section of that and put the letter on record. We were talking about the capital standards that are being developed by the IAIS, and your response to the capital standards being developed by insurance experts will not have any legal effect in the United States unless they are implemented by U.S. regulators in accordance with U.S. law, which of course is the answer that I wanted. I appreciate the answer, but I need to push it a little further. And I say that because I'm not opposed to internationalization. It's going to happen. I just think that we shouldn't put the cart before the horse. We haven't cleaned up our own house fully yet. I'm not ready to pass it all over to an international standard. I want to make sure that I understand this correctly, though, that by doing so, I want to make sure that how I understand in accordance with U.S. law, I want to make sure that this is not some backdoor way to allow some Section 4807 of some treaty with some country I've never heard of to overtake our capital standards in insurance to say, well, we have a treaty that we signed 400 years ago, and we have to therefore give it up. I presume that you're not looking for that back.
No, Congressman, I think it's worth taking a step back and talking about how important our involvement in these international bodies is. We could do an outstanding job in the United States putting a system in place that's safe and sound for all of our financial institutions, and we're still exposed to vulnerabilities if around the world the standard isn't raised as well. So we simultaneously participate in international discussions, and in a case like this, our insurance experts are very much part of shaping the international debate.
As I think you should. I think you should be at the table, and I do think that you should participate, and I do think you should have a strong voice. I just don't have faith at the moment. I may have in some future time that the international standards are going to be any better than we can do for ourselves.
And while our participation in the international process often leads to a result that reflects our judgment of what the outcome is, we retain, as do all national authorities, the right to make a decision.
But
in the case of insurance, it's the states that have a lot of the authority.
Part of the other question, though, is number one, is I'm not looking, I want things straightforward. I believe in FSOC. I believe in what you're doing. I do believe that internationalization is coming, but I don't want to find out the day after that somehow through the back door we gave up our entire system of insurance regulation without knowing about it. If we do it, I think we need to do it conscientiously, and I don't want to find out that some treaty did it, and I don't want to find out somehow that because somebody from Liechtenstein had a better idea that now they run our insurance industry. And I don't expect that that's going to happen, but I need to put that on the record.
That is not the way it works.
You also talk about transparency. That as far as I'm concerned, I back up one second. I also want to go and find out that under Dodd-Frank, as I understand it, the Fed and others have oversight on insurance companies that are SIFIs or that have savings and loans holding companies. Other insurance companies are not subject to federal regulation. And I'm just want to make sure that there's not some backdoor way to expand jurisdiction. Though I do believe that federal optional charters will come someday. They're not here yet. And I just want to make sure we're not trying to do that in a backdoor way.
It's definitely not any kind of a backdoor into federal regulation of all insurance, though there is a debate to be had, as you note, as to what the right balance between state and federal is. But that has to be done directly if it's done.
That's what I wanted to hear. I also want to talk a little bit about transparency. You also agree that transparency is important. And up until now, there's been give and take. You get transparent, and then you don't get transparent. And for me, one of the things when it comes to designating SIFIs is that the SIFIs know what the measurements are, or the potential SIFIs know what the measurements are. My argument is it's like a traffic cop. If a traffic cop is sitting on the highways, the truth is most of the time I want the blue lights to be flashing because I'm not interested in catching somebody going 3 miles an hour over the speed limit. I'm interested in keeping them at the speed limit, and the best way to do that is let them know that there's a cop on the highway. And same thing here. I'm not interested in catching someone into a SIFI if they want to avoid it and can avoid it. And the only way that can happen is if FSOC and others tell them, here's the measurements we're going to have. If you choose not to participate in these measurements between now and 6 months from now, you can take action to avoid it. Why is that not possible?
Brief answer, Mr. Secretary.
I think that the standards that are used in FSOC actually are understood by the industry. We put out detailed rules early on in the process. When it gets to the point of actually engaging with a company, there's an enormous amount of give and take back and forth, which gives them the ability to make judgments as to how they want to organize their risk.
I think we'll have to follow up with that at a later time.
Time of the gentleman has expired. Chair now recognizes the gentlelady from West Virginia, Ms. Capito, Chair of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman. As I mentioned in my opening statement, I believe that the process for designating the financial institutions, that process should be based on activities of the institution as opposed to just arbitrary cutoff points. For instance, the $50 billion level, and then we have another level, $10 billion for the consumer supervision. And what we're finding, I think, is, and this sort of pivots a little bit off of the previous questioner, is if you have these arbitrary deadlines at $50 billion, you could have a financial institution that is maybe at $35 billion that's much riskier than somebody, say, who is at $100 billion because of their business platforms, their business, and the way they've structured their business with less and fewer risks. Yes, hello again. So I guess what I would ask is, and Governor Torrillo talked about this about a month ago, mentioned, just kind of threw out $100 billion to raise it up, because folks who are falling in those thresholds are having difficulty. How do you feel about that, rather than have an arbitrary asset limitation, to maybe look at what the risk profiles and base those designations on that?
Well,
I know that's a discussion.
The threshold does not lead to a designation automatically. There's only a designation if the analysis done suggests that there is a risk that that determines that it's systemically significant. And I think that the number of designations reflects the fact, we've seen the non-bank utilities designated. We've seen 2 insurance companies designated. It's not been
But I think in the case of the banks, if they reach the $50 billion threshold, it is automatic.
I thought you were talking about the FSOC designation, the threshold.
Well, I'm talking about that in conjunction with, I guess, the other designations of significantly systemically important.
As far as the banks, I think after the financial crisis, the burden certainly was on us to take a closer look at systemic risk in large institutions. And as we go through that process, as the regulators go through their more detailed reviews of both the financial conditions of those banks and their systemic risks, I think it's a discussion that we can continue to have. But I think for the time being, we have to look back and forward. We weren't where we needed to be in 05, 06, 07, and 08. We need to make sure that we have visibility into any of the institutions that could create that kind of systemic risk. And as far as the designations by FSOC go, the same standard, I think, applies. We're not looking to designate for the sake of designating. We're only looking to identify where are there areas of systemic risk that if we look back at the next financial crisis, we would say, why didn't you catch that?
I think that in the case of Prudential, they would argue, this is a slightly different question, they would argue that if they were to fail, their business model would not drag down the entire financial system. What kind of metrics were used for that, and how does that? Yeah, what kind of metrics did you all use to make those determinations when the insurance expert on the FSOC had a deep question about that?
There were detailed analyses done, and there was a hearing where Prudential came and exercised its right to ask for a hearing. And I think that the kinds of questions that you ask when you're looking to make the determination like this don't have to do with what happens if the company fails in good times. It has to do is what happens if there is a financial crisis and the company fails? What happens if it's a situation of great stress in the system? And that's not necessarily what regulators previously did, but when we saw what happened in 07, 08, at a time of great stress in the financial system, things do happen that don't happen at other times. And that's the kind of inquiry that we went through.
On the regulatory, I've asked you this, I think, every time you've come before us. Mr. Meeks and I have a bill out that would modernize and streamline the financial regulatory framework. We're hearing consistently, particularly from our community banks, but others, that the piling on of the regulatory burden is really becoming a chiller in terms of being able to move forward with business. And you mentioned that once every 10 years there is an analysis of this. I mean, I think 10 years is too long a period, especially since a lot of these have gone into effect over the last 4 years. So what efforts are you making in that?
So, I have a certain amount of background in this because when I was OMB director, I conducted a review of all the executive branch agencies to do a look back, and we asked the independent regulators to do a similar look back. We didn't have the authority to direct them to do that look back. I think that at the moment, with the 10-year review coming up, the regulators have indicated it is their intention to do that kind of look back. I think that's a very important thing.
Thank you.
Time of the gentlelady has expired. Chair now recognizes the gentleman from Texas, Mr. Hinojosa, for 5 minutes.
Thank you, Mr. Chairman. And thank you, Secretary Lew, for your testimony today. Before the financial crisis that caused the Great Recession, the U.S. had many financial regulators, yet none took a comprehensive look at the economy as a whole. We were caught off guard because no one was tasked with looking at the big picture. Congress created the Financial Stability Oversight Council as a cornerstone of the Dodd-Frank Act. It serves a critical function to keep watch for emerging financial threats. So, Secretary Lew, prior to that passage of Dodd-Frank, what government agency, if any, was responsible for looking at the systemic risk in the U.S. financial system?
Congressman, I think one of the things we learned is that there was no single agency that had responsibility for looking across the system and identifying issues of systemic risk. One of the reasons FSOC was created was to make sure that in the future, agencies collectively and a body chaired by the Treasury Secretary would be charged with that responsibility. I think it's critically important. I don't think that it would be responsible for us to go back to a world where you don't have that kind of ability to look across the different silos. And that's not to say that the regulators weren't regulating the industries they had responsibility for. They weren't necessarily looking at the interconnections and the way that the entire systemic risk profile developed. That's exactly what FSOC does. It's why it was created. It's why we need to be able to ask questions. It's also why we need to be able to ask questions when we don't know what the answer is. It ought not to be that we have to have near certainty that there's a problem in order to ask a question. We have to be able to turn over a lot of stones and have the good judgment to only designate if the analysis of the facts warrant it.
Secretary Lew, last week the committee passed H.R. 4387, the FSOC Transparency and Accountability Act. This bill would subject the FSOC to the Sunshine Act, expand its membership, and change voting protocols for commission and board members. And it would allow members of Congress to attend and participate in FSOC closed-door meetings. In addition, this bill, H.R. 4881, would prevent the FSOC from any further actions related to the designation of a non-bank SIFI, including even talking about the possibility of the designation for 1 year. But undermining FSOC, we undermine our ability to avoid a future crisis like we've just experienced. Secretary, how do you view the bills passed last week out of this committee, and what is your primary concern?
Well, Congressman, I think that transparency is important, and we are trying to develop policies that make that very clear. I also think that there needs to be a space where financial regulators can have a conversation about confidential information that's a protected space, and the balance is an important one to strike. I think the notion of complying with as much of the Sunshine Act as possible is something that we've reflected. Much of the Sunshine Act is reflected in the FSOC procedures, but because of the balance, it's not 100%, and I think it's the right balance for now, and we need to continue to work to strive for striking the proper balance. As far as the participation of members of Congress, I would just point out that executive branch meetings happen every day, all day long, and it's not considered the norm or appropriate for there to be congressional participation in executive branch meetings. I don't think it would be appropriate here either.
In looking at your annual report, the FSOC delineates recommendations to improve the health of our financial markets. Interest rates have been kept to a historic low in order to encourage lending and spur economic growth. To offset the effect of low interest rates, the banks and credit unions have increased risk-seeking behavior, such as extending the duration of assets and easing lending standards. So let me ask you this question. How much does the risk of increased interest rate volatility concern you?
I look at all of the different moving pieces in our financial system to keep track of them. Obviously, low interest rates do produce a certain tendency for there to be a kind of rush to yield. We've seen a narrowing of yield curves that suggests that. I don't think that if you balance the kind of where we've come in our economic recovery and the policies that have led there, I think that we're in a place where this is a question that the Fed and others have to look at, but I'm not going to comment on monetary policy.
I yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Texas, Mr. Nagebauer, Chair of the Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. In his dissent, Roy Woodall, who's the FSOC's designated insurance expert, stated that the underlying analysis for the prudential designation used scenarios, and I quote, atypical to the fundamental and seasoned understanding of the business of insurance, the insurance regulatory environment, and the state insurance company resolution and guaranteed fund systems. Do you agree with Mr. Woodall's statement?
Congressman, obviously the FSOC decision was one that I participated in. I thought the designation was appropriate and the risk analysis warranted it.
So you disagree with his statement?
Well, I'm just going to comment on what informed my judgment in terms of the decision that we made.
So just for the record, Mr. Secretary, what is your background as far as experience in regulating insurance companies?
I don't pretend to have been an insurance regulator. I've worked on insurance policy as a policymaker from time to time. But I think that the responsibility each of us has as FSOC members is to look at a very detailed analysis that's prepared by all of the staffs of the FSOC. It is quite voluminous and detailed. In the case of the prudential designation, I participated in the hearing, and you make your judgment based on the record that's prepared.
So when you don't have a background in that industry yourself, I guess one of the reasons that Congress decided to put these insurance people on the FSOC process was obviously a lot of the regulators that for example, the Fed and the Treasury and others don't really have much background or experience in regulating insurance companies, do they?
Well, Congressman, I would say if you look at
do they have a background or experience in doing that?
For the most part, they have backgrounds in the field that they are in, whether it's banking or securities. But
Yeah.
I think that if you look back at the financial crisis of 6 and 7 and 8, the insurance industry was very integrated into the financial system and was very much part of the cause of a systemic collapse. So I think that the question...
The insurance industry was...
Parts of it, yeah.
What part was that?
Well, the AIG was part of it.
But that wasn't the insurance aspect of their business, though, was it?
Well, the inquiry about systemic risk is one where you look at all of the activities of a firm and you look at whether or not it has transmission channels, if there's a problem in that, into other parts of the financial system. And I thought, and I continue to believe, that the analysis done was of very high quality and it warranted the determination. And I'll just point out that there was not an appeal of the judgment either.
Well, one of the reasons for designating Prudential as a SIFI relates to FSOC's asset liquidation analysis. Are you familiar with?
Yes.
Yeah. In which it assumes that simultaneous runs against its journal and separate accounts by millions of life insurance policy holders and a significant number of annuity and other contract holders for products with cash surrender value. This assumes a scale for which there is no precedent. In other words, was there anything that in Prudential that you would indicate that they'd ever experienced a catastrophic liquidation of policies or surrender of policies?
The question is not whether something has happened, but whether there is a systemic risk in the future. And I think the scenarios that you look at tend to be scenarios that have not been experienced, because your goal is to avoid having a financial crisis that you could avoid.
Well, the only problem with that, Mr. Secretary, is trying to forecast cataclysmic events. Really, I don't know if anybody has any expertise in doing that, but trying to come up with these what if, I could come up with a lot of what if scenarios where you wouldn't want to put your money in any financial institution. But the problem is when you start going down this road, is that you impact the business model and the customers that rely on a lot of these financial products for something that you're not sure is going to happen in the future, that has not happened in the past. And so I think, and then when you ignore the expertise of people that have been put on FSOC to give you some guidance in that area, I think that's one of the reasons that you hear so many of us question, the methodology that's being used in this process.
Well, Congressman, I don't disagree that the scenarios that you look at are not the likely scenarios, but that's not our task. Our task is to look at, in a crisis situation, is there a risk of financial stability being undermined? And, we know what the recession of 08-09 looked like. We know what the Great Depression looked like. There are scenarios that we've gone through in our history, and it's not just pulling scenarios out of the air. The question is, in a time of great stress, is there risk? And if there's risk, it doesn't mean that you're changing the business model all that dramatically. It's a question of, is there greater oversight and greater scrutiny?
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you. Over here, Mr. Liu. Thank you and welcome. I think you're doing a fantastic job. I want to first of all ask for a little help that you could give for me and my constituents in Georgia. You're familiar with the Hardest Hit program.
Yes,
it's
ma'am.
your program, thanks to the hard work of this committee. I would deeply appreciate if you could assist us. We've got an issue in which my state was about a year late in getting this money out to help the hardest hit. Subsequent to that, we have unleashed or unloaded a number of veterans who happens to be one of the fastest growing groups of the homeless. And that's because they're coming home and their houses are being foreclosed on and mortgages. So within the next couple of months in August, we're putting a big event together down in Atlanta. In order to get moving on this, your predecessor, Mr. Tim Geithner, and the Assistant Treasury Secretary under who started this was Mr. Tim Missad, who did excellent work. But unfortunately, both of them have gone. So what we need is just a nice call down to the Georgia Department of Community Affairs, first thanking them for moving, but reminding that because of that 1-year delay, we only have 3 years left. By 2017, as you know, if we don't get rid of that money, it's going. It would be a shame that we have veterans coming home seeking employment. This is targeted just for them. So just a call down would be very helpful to the Department of Community Affairs, asking if there's any assistance that Treasury can give them, because if it weren't for Tim Geithner, Tim Masad coming down with that event to light a fire down in Georgia, we would not be moving as we are. I don't want a dime of that money coming back when we have soldiers coming home who are living on the viaducts because they can't get that kind of help. So I appreciate you doing this, and we will get the information to your offices to whom to call. Now, I have another point. I want to get to the emerging threats to our financial stability on the international stage. You've just returned from an international visit and working in this issue with some of our other counterparts. Also, Treasury is the enforcement arm for the Iran sanctions. 6 months is coming up. Can you give us in a nutshell where we stand relative to the impact of the standstill, where we're on those sanctions, and what are the emerging threats internationally?
Well, Congressman, first, on the hardest hit fund, I would welcome the information, and Tim Bowler is running that office, and I will have him follow up as appropriate.
Thank you. My staffer will get in touch.
As far as the Iran sanctions go and the negotiations that are taking place, I think 3 points. First, the sanctions have been extremely effective. They have had a dramatic effect on Iran's economy. They've actually crushed Iran's economy and brought Iran to the negotiating table. The joint plan of action was very limited relief. It was several $billion of relief, not enough to reverse the harm that the sanctions does to Iran's economy. And in fact, the ongoing impact of the oil restrictions in the sanctions does more damage than the relief granted. So the impact is building up, not reducing. Third, we've made it clear that we're committed to these negotiations, but not committed to a deal unless it's a good deal. No deal is better than a bad deal. We hope there's a good deal. We're in the final month. I think that it will be an important month that determines whether or not there's seriousness on Iran's part to set aside its nuclear weapons program.
So we're at that final month, which is the apex of my question. Where do we go from there? Do we go back to square one, or will there be an extension asked for?
Well, I'm not going to prejudge what the end of the month is. There have been no discussions to date of an extension. There's also not going to be pressure to take a bad deal because we're hitting a deadline. I think we'll have to see where we are at the end of the month. What we have said is that if the talks break down, if Iran is not willing to make concessions, we will look for tougher sanctions, and we have taken no option off the table to make sure Iran does not get nuclear weapons.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. McHenry, chairman of the Oversight and Investigations Subcommittee.
Hi, Secretary Lew. Thank you for reappearing. And, we had a hearing about the OFR Asset Manager Report, and former Assistant Secretary Michael Barr testified that the OFR report was, quote, was not something I would hang my hat on, end quote. Would you hang your hat on the Asset Manager Report?
I don't hang my hat on reports, Congressman.
I'm not, I guess, metaphorically.
The report was one step in the process. It is not a decision by FSOC. It was something that FSOC asked for as one of the things to consider. We've done a lot of other work as well, analysis within FSOC, and we had a public session, I believe the day before your hearing, where we had broad participation by the industry and by experts from academia, including Michael, who testified. I think that one of the important things to remember is FSOC has made no decision to designate asset managers. All FSOC has done is asked the question. I think it's really important to ask the question, and the answer could be that there's no need to designate. The answer could be that there's some other course of action that's advised, and we will continue to pursue that.
And to that end, Chair White testified just a few weeks ago before this committee that the SEC has all the authority necessary. No new authority would be needed for the SEC to regulate the asset management industry. Do you concur with that assessment?
You know, I think it depends what the answer is in terms of what's the appropriate step to take. And, you know, I'm not going to prejudge the outcome of an inquiry that's not completed.
Okay. Let me try that again. Do you believe the SEC has the authority necessary to regulate the asset management industry?
I believe the SEC does have authorities to regulate the asset management industry, but you know, whether it's the precise authority depends on what the mode of regulatory response, if any.
Yes, and thank you for clarifying, and that is helpful and very forthcoming. And so, you know, we've got a number of other questions, obviously, but with the FSB, a number of us have questions about the process, and you've answered this to some degree, but we have many of us have complaints about how non-transparent the FSOC is, but the FSB is even really less so. And so when the FSB designates G-SIFIs and all those G-SIFIs within that category of investment companies are only U.S. Registered investment companies, it becomes problematic for us to see that to judge whether or not the FSOC will take that same tact from the FSB. And so to that end, in order to help us better understand the policymaking process, would you help us with better disclosure of what those discussions are like and what the discussions are at the FSB just going forward? I think that would be helpful in terms of transparency and in terms of making sure that we are asking appropriate questions and you don't have to answer the same questions over and over again.
Well, our staff does try to keep congressional parties informed. We will continue to do that.
Currently, I would say it's not sufficient. And so will you try harder to do better when it comes to transparency with the FSB?
I try harder to do better at everything I do every day.
That's a fantastic commitment. So no hats and try harder. All right. Well, to that end, let me ask you another question, if we can get to this. We've passed a couple of major pieces of legislation through this committee and off of the House floor that are bipartisan in nature, right? And some help credit unions, others help community banks. You know, basically lightening a bit of the overreach that the large bipartisan vote in Congress is shown. One is the the swaps push out bill that passed 292 to 122 on the House floor, and the end-user margin bill, which passed 411 to 12. So there's a way for us to pass bipartisan legislation. Give us your view. What's your encouragement for Congress to undertake bipartisan regulatory changes?
Look, in principle, I endorse bipartisan legislation as a general matter.
But in a specific matter, would you help us with this process?
On the question of Dodd-Frank amendments, you know, frankly, there's been an issue for the last 4 years where the question is, do you just make technical fixes or do you go back and make broader changes? That's an important question. We don't think there should be a broad review of Dodd-Frank. There's also a question as to whether or not you give agencies a chance to implement things before you legislate again, putting an overlay on top of it. But I'm happy to continue the conversation with you.
Time of the gentleman has expired. The Chair wishes to announce to all members at approximately 11:30 the Chair intends to call a 5-minute recess. The Chair now recognizes the gentleman from Missouri, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Secretary, for being here, and we'll also receive your thanks for us sending Mail Watt from this committee to the Oversight Council. We're pleased.
We appreciate your sharing him.
Yes. Mr. Secretary, I've got two questions, and do you believe that as a result of FSOC that we do have an authority that is accountable and responsible for monitoring the financial stability of the U.S. economy, essentially. Do you believe that without FSOC, the dangers would be increasingly more ominous?
Look, I believe we have a much higher level of visibility into the financial stability risks. We have relationships between regulators that are stronger and deeper than they ever were before. And we have the capacity, if we need to, for people to collaborate together in a much more effective way. I think all of that leaves us much stronger than before, and to give that up would put us back where we were in 07 and 08, when regulators worked in their silos, and it was very hard to break through to look at the broader financial stability.
Well, that's interesting, because I'm wondering how comfortable the members of this committee should be that the expectations that an American financial institution is still too big to fail. I mean, these huge interconnected bank holding companies and or the non-bank financial giants. I mean, how comfortable should we feel that the too big to fail has been either dramatically reduced or eliminated?
Congressman, I think we have made enormous progress. We have much more capital in our banks. We have resolution authorities that are now in place and being exercised, so that institutions, if they hit a failure, they have a way to unwind without necessarily causing the kind of systemic risks that we saw in 07, 08. We have living wills for the largest institutions that have very detailed plans of what they would do if they got into distress. And I think if you look at the question that's often asked about the implicit subsidy for large banks, that is a reflection of the market's belief that there is a willingness to step in, we're seeing that way lower, if not eliminated. I mean, it has been reduced by academics who study it. It has been reduced when the IMF looked at it. It has been reduced when rating agencies look at it. So I wish I could tell you with absolute certainty that too big to fail was a thing of the past. What I can say is we made enormous progress. We will continue to work at the kinds of sensible ongoing policies that will make our system even stronger. And the test, unfortunately, only comes when you have a financial crisis, which I hope we don't experience.
Yeah, I was going there, that we won't know for sure, as we didn't. I mean, I was on the committee when Secretary Paulson and others came in and told us essentially that if we didn't do something before the Asian markets opened the following Monday, that the world could fall into a depression. I'm assuming you're saying we can have a degree of greater comfort, but that comfort should be measured, because we don't really know and won't know unless we hit another.
I would add, Congressman, that many of the authorities that existed at the time have been changed in Dodd-Frank, and we don't have the tools that Secretary Paulson had at that time.
Of course, he didn't have the tools.
Yeah.
He made the tools up by his
and
own admission.
But there were changes made in Dodd-Frank, that limit what both the Fed and Treasury can do. So we have less ability to step in, and it would require Dodd-Frank, as a matter of law, ended too big to fail. It would, so there is an obstacle, and that would be a change in law to step in to exercise some of those authorities.
Thank you. I yield back to Councilman Van.
Gentleman yields back the balance of his time. Chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, for 5 minutes.
Thank you, Mr. Chairman. Mr. Liu, welcome. And quick question for you with regards to mortgage servicing assets. FSOC seems to be intent on trying to implement new capital standards on these folks. And I guess my first question is, where's the problem? And what problem we're trying to solve? Where's the risk?
Congressman, could I just ask for clarification? What capital standards are you referring to?
There's FSOC capital rules on mortgage servicing assets, and what we're seeing is that the small banks, even large banks, are selling all their mortgage servicing assets to non-banks as a result of the capital rules that are being implemented.
So we are definitely seeing that there are higher capital standards for banks, in general for banks. And to the extent that banks choose to change their business plans and get out of one line of business or into another, that's obviously something that we need to keep an eye on.
Well, basically, I guess maybe let me back up here. The Basel III rule was the one that really is impacting this, and it's again, it's something that's concerning to me from the standpoint that we're allowing the foreign rules and regulations, which to my knowledge, they don't have mortgage servicing asset activity in foreign countries. So we're the only one that does this sort of activity, and yet we're allowing the Basel III rules, which are basically foreign rules, to impact our way of doing business here in this country. Number one, where's the risk? What's the problem? And why are we allowing the entities from other countries to regulate a business that is basically American in nature?
Well, the capital standards that our regulators have put into place are actually in some ways tougher than Basel III. So it's not that Basel III put the capital requirements in place. Our national authorities have to put our capital requirements in place. We have driven Basel III to a higher standard because one of the things we worry about is that a risk that we face is that other countries don't have the capital requirements that we have, and their banks are not going to be as sound as they need to be.
This is about mortgage servicing assets. The servicer of these assets, where's the risk with a servicer, somebody who services loans?
I think the question actually is a broader one in terms of
No, it's pretty specific. Where's the problem that entities that service loans need to have more capital?
I mean,
where's the connectivity to our financial system that causes a greater risk that they have to have more
capital requirements are on all of a bank's assets. That I think is really the issue. But I'm happy to follow up with you on the specific question of mortgage servicers.
Well, it's interesting because as we go through this process, I think with the previous question, one of the folks I think was talking, maybe it was Mr. McHenry. We're talking about some of the stress tests that banks are doing, and the big banks' modeling is allowed to be different than it is from smaller banks. And yet, when you allow them to design their own modeling, you come up with a completely different capital ratio as if you would use that same modeling for smaller banks. And so I think you're using two sizes to two different sets of rules with regards to big guys versus little guys. And I have a real problem with that. And it continues to be rampant through all of the things that the Treasury does. Well, two sets of rules.
The regulators have gone to great lengths to try and reflect the special circumstances around small banks and community banks. And it's not the banks that set the standards for stress tests. It's the regulators who conduct the stress tests. So
yeah, but Mr. Secretary, you're allowing the banks to also determine their own models on how they determine their capital, and that's not right because you have to have the same set of standards for everybody. You can't have two sets of standards, and it goes back to, well, I just have a real problem with that particular. Let me just go. I only got 24 seconds left. Your comment a while ago that insurance companies were a part of the cause of the collapse of 2007, 2008, which I wrote down here. It's stunning, absolutely stunning. I defy you to give me an example of one insurance company that's truly the insurance part of their business was a cause of the collapse. Tell me, was an insurance policy, an insurance rate, an insurance lack of claims processing, was that a cause of 2008, 2007?
I used AIG as the example. And
Mr. Secretary, you know as well as I do that AIG, the financial portion of that company, it wasn't the insurance portion of that company. It was the financial portion of that company that was the problem. The connectivity of that. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, for 5 minutes.
Thank you so much, Mr. Chairman. And Mr. Secretary, it's very nice to see you. Thank you for coming to speak with us today. I guess I was looking through your testimony, and I couldn't agree more that the formation of the FSOC was an important strategy toward having all of these senior regulators and principals look at the system across the spectrum because I was here again when Mr. Paulson came with this 4-page bill saying give us $700 billion. Don't want to go through that anymore. But my question is, I think that a good process leads to good policy. So I guess I saw Mr. Roy Woodall, the FSOC insurance expert, dissent from the decision to designate Prudential. And yet they were designated as a SIFI. And then we saw the SEC push back against FSOC on asset managers and aspect of money market mutual fund reforms. And of course, the SEC is the expert on these industries. So I guess I would like, you'd think it would be helpful for us to have a sense of how you see the role of the primary regulators in these discussions. Is there any deference to them? Did they just dissent from the decision so that they could, so that they wouldn't be on record as being against their industry? What are we to learn from the experts of the FSOC seemingly having less of a voice?
Congressman, I actually think all the members of FSOC have a voice. They're listened to, but ultimately not everyone will agree on every issue. I think if you look at those issues separately, I've spoken at some length on the review of the insurance companies before the designations were made. I believe the record was a robust one and it warranted the decision. Obviously not every member of the council agreed. But the decision stands, and the company has not appealed it through the courts as it could have. And I actually think the process was one that reflected rigor and analytic quality, and I'm both comfortable with and concur with the judgment that was made. As far as the issues you raised with regard to the SEC, obviously FSOC spoke to the money market fund issue before I was chair of FSOC. It is an issue that was, again, at the heart of the financial crisis in 2008. And there was, I think, an urgency that was felt by FSOC to underscore that more action on that and on other issues that relate to the area of shadow banking was important. The SEC has the direct regulatory authority. They are working on a rule. I'm very hopeful that they will complete a rule this summer.
Mr. Liu, thank you so much. I don't have much time, but I do think the SEC did push back on the aspects of money markets. That breaking the buck thing was resolved. Finally, I guess you've heard the complaint that prior to designation, which is a big deal if you're designated as a SIFI, there's not an opportunity at all for the designee to present their case to the full board of principals of the FSOC, or even to directly address the final information charges that are being presented to justify the decision. This seems to be just a little bit contrary to what we know as due process. I just want to know what your response to that is.
That's not correct. First, let me go back on the money market fund issue. I just want to remind everyone on this committee that there was a real problem in money market funds in the financial crisis, and the challenge to solve that crisis fell not on the SEC, but it fell to the Fed. So it was quite appropriate for FSOC to take a view, and frankly, it is very appropriate for us to continue to take a view to make sure good action is taken.
And
we'll all have
we have 23 seconds, so I do want you to answer that other question, Mr. Liu.
Remind me the second question.
Okay, it is the people don't get a chance to present their full case.
That's not correct. There is extensive back and forth between a company and the FSOC during the Stage 3 process.
Stage 3?
Yeah, extensive, and there's no designation until the end of that. At the end of the Stage 3 process, they have a right to a hearing, and only one company has sought it, but we had a hearing. And then they have judicial rights of appeal after that. There is
Stage
robust
3.
due process.
Oh, okay, thank you so much, Mr. Secretary.
Time of the gentlelady has expired. The committee will now stand in recess for 5 minutes. The committee will come to order. The chair now recognizes the gentleman from Alabama, the chairman emeritus of the committee, Mr. Baucus, for 5 minutes.
Thank you. Secretary Lew, this whole "the dog ate my homework" defense that the IRS and the lowest learners using, the American people are not buying it. But more importantly, I think it calls into question the integrity of the process, and I think it's very disturbing to all of us. We have computer crashes in our office from time to time. I think every member has had them. And you immediately call in the technology people. You make sure that the hard drive is preserved, and you don't lose emails. So I hope you will investigate this as secretary of the agency and find out what happened.
Congressman, I think we all know that hard drives do crash, and that's what happened here. In 2011, when the hard drive crashed, efforts were made to recover what could be recovered. And subsequent to that, after it became a matter of interest, extensive efforts were made to put back together what could be put back together.
All right.
I believe that you know, Commissioner Koskinen has testified to this. A report has been sent to Congress.
Oh, well, I'm just
in great detail.
I'm just saying I think the American people are still waiting on a good explanation. Let me ask you this. I've always been struck that orderly liquidation has struck me as a convoluted and kind of a highly subjective process that does little to end too big to fail. And it gives an enormous amount of discretionary power to regulators. And FSOC makes resolution advice or gives recommendations to the FDIC. The Judiciary Committee, with the Financial Services Committee, is looking at possible changes, several possible changes in the bankruptcy code that we believe that are properly constructed. Bankruptcy would be a better way to deal with the resolution of failing institutions. You've got established presidents. Do you think that it's a worthwhile process for Congress to consider this approach?
Congressman, I think that orderly liquidation authority actually is an effective implementation of the law in Dodd-Frank. Obviously, it's not the same as bankruptcy, but it is a process that has actually become one that the world is now looking at to see if a single point of entry system.
So you don't think the bankruptcy process?
I would actually be interested in following up with you what the changes in the bankruptcy code would be. What I was going to say is, I don't think that all wisdom was contained in the actions taken in the wake of the crisis.
Yeah, we would like to work as partners on this as we go forward, because I think.
And I don't know that it's instead of orderly liquidation authority. I don't know if you would. I would not take the orderly liquidation authority away, and I don't know what proposals are, but I'd be happy to look at them.
And I'm not sure we do yet either. Congress 6 months ago was told that there'd be more coordination and guidance on the implementation of the VOCA rule. Unfortunately, I've not heard of a lot of follow-through on this pledge. Would you review with us what is being done to provide financial services providers with guidance they need to comply with the many complexities of the VOCA rule, and give us some assurance that implementation questions that were posed to the working group will be answered? I know 6 months later, only 6 of those 80 questions have been answered.
Congressman, I think the fact that an identical rule was issued on the same day by all the agencies actually was an important step to giving guidance. My fear was there would be differences that caused confusion, and I think it's very important that there's one rule. So I actually think that that is the foundation. It hasn't actually gone into effect in terms of compliance yet, and the regulators are working amongst themselves as they go into the implementation stage to stay in close contact, because there is obviously the risk that you end up with common law in each of the agencies going in different direction. That's not an area that we have direct responsibility over at Treasury or through FSOC, but I think it's an important question, and it's one that I ask the regulators as well.
Right. They still need more guidance in complying with VOCR, and I appreciate your willingness to give that. Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Delaware, Mr. Carney, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Secretary, for coming in today. Thank you for all your good work. I've been reading through the FSOC annual report, lots of good information and data in there. One of the things that's discussed in the annual report is the repo market as an area of vulnerability for our financial system. And in fact, in a hearing back in February before this committee, Governor Tarullo cited the repo market as the second greatest threat to the stability of our financial system after adequate capital requirements. Do you share Governor Tarullo's concern, and what steps can be taken to prevent adverse consequences in the repo market during stress markets?
I think that the short-term funding issues are quite significant. That's why, whether you call them short-term funding or shadow banking, we're putting so much attention into them. The risk that one day you open for business and you don't either have the repo or the money market funding that you expected, we saw in the financial crisis, can cause an immediate collapse, and it's a collapse with an accelerant on it. I think if you look at the amounts of funding that are in the repo market and the money market funds, it's considerably down from where it was at the time.
So less of a risk, but what can be done to prevent some of the adverse effects?
So I think on both those issues, on the tri-party repo and on money market funds, it's important the regulators continue to look at the issue and take action. So the Fed has a responsibility in the area of repo. SEC has a responsibility in the area of money market funds. I know that both are working on additional steps that could be taken to further reduce the exposure. There is an efficient market there until there's not.
Right.
And the question isn't what happens when it's working well. The question is, what safeguards do you have that you won't see a moment where it collapses? And that's why I think the Fed is looking at what actions it can take, and why it's so important the SEC finalizes a money markets rule, because I think they are really parallel kinds of risks.
So moving on to GSE reform, there's been some discussion about it. Unfortunately, my colleague, Mr. Perlmutter from Colorado, is not here, but he and I have a kind of a different perspective on it. Your report identifies it as an important issue, but it doesn't say too much about what the negative consequences of not doing reform. I've been working with Congressman Delaney and Congressman Hines on a piece of legislation that would provide a government backstop with more explicit guarantee. What's your view on the risks of not doing reform in the short term?
Well, look, I believe that housing finance reform is really the unfinished business that didn't get addressed in the immediate wake of the financial crisis. And we've seen only recently, with the estimates of the exposure that taxpayers ultimately have to the GSEs, that were there to be another crisis, we still have the system that we had before, which wasn't very good.
With greater exposure.
Great exposure. So I believe that housing finance reform is very important. I think there's a lot of progress that's been made in the Senate working towards a bipartisan approach on this. I think there has to be a bipartisan solution. And the key to a solution is making sure that there is access to finance, making sure that there is a clearly delineated responsibility that's not a government responsibility in terms of losses, particularly first losses, and to the extent that there is any remaining government backstop, that it be extraordinary circumstances and well defined.
Right.
I think that the process in the Senate did make great progress on that. It's obviously not finished, and I would hope that a bill can get to conference so that it's an area that we can see bipartisan legislation on.
I hope so too. I don't have much time left, but there's been a lot of discussion, actually a couple of pieces of legislation introduced here in the House about differentiating among financial institutions, banks, based on different criteria than just size. In fact, Governor Tarullo mentioned a few weeks ago that maybe SIFI designation should be on firms that are $100 billion or greater. What's your thought on that? We have a legislation here, Mr. Luke DeMeyer, my colleague Mrs. Sewell, has introduced that would differentiate on qualitative measures. Do you have any views of that?
Look, I think that it is hard to have a hard view that there's a size that makes you financially significant and creating the risk. The question is, does the combination of your size, your structure, your interconnection to the system, and it's something that requires our ongoing analysis.
Thanks very much.
Time of the gentleman has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy.
Thank you, Mr. Chairman. Welcome, Mr. Liu. It's nice to see you back at the committee again. Just a couple questions on emails. How does the Treasury back up their emails currently?
The main Treasury, I believe, has an auto backup, but I'd have to get back to you on the specific details.
So with all the information about emails and backups and IRS and Treasury, housing, IRS, you have no idea how your emails are backed up?
I'll just say that the main Treasury is much smaller than the IRS. It has a different volume, so it's a different kind of an email system.
How about with the White House?
It's my assumption that everything is backed up.
I'm sure okay. How about the White House? How does the White House back up its emails?
So I'm not an IT professional, Congressman.
No, well, neither am I, but I know as a former state prosecutor how the state of Wisconsin backs up our emails. I know how the House backs up our emails as a congressman. You're the chief of staff, and I'm not an IT expert either, but you can't tell me how they're backed up?
When I was at OMB and when I was at the White House, there was auto backup, but there also were occasionally periods when machines broke.
And in regard to machines breaking, when you were the chief of staff at the White House, did you have a hard drive crash?
My personal hard drive?
Yes.
Not that I recall.
Okay. When you were the chief of staff at the White House, did you have meetings or a meeting with any IRS employees?
I do not remember. I mean, it's quite a while ago, and there's been a lot since then. I would have to go back and check.
So you haven't pondered that question with all the.
I did
news?
not. I certainly
well,
had.
If I could ask the question, then you could respond, please.
No, look, I'm happy to go back. There were meetings that involved people from different agencies. Where you
So
talked
the
to
answer is yes.
people.
You did meet with
I don't
IRS
remember.
employees.
Yeah, the answer is I don't remember, but I'd go back and check if I could. I mean,
I'm sure you can't recall.
I never had a meeting on any IRS policy matter that I recall. The question you're asking
political
is a broader
matters?
one. Yeah. Pardon?
Political matters?
No, not on political matters either.
Did you have any email correspondence with anyone at the IRS?
None that I recall.
When did you first learn about Lois Lerner's emails being lost or hard drive crashing, and those emails from 2010 and 11 having gone missing? When did you learn about that first?
I only learned about it roughly the time the Congress did when it was.
So you learned about it in the press?
Pardon?
You learned about it in the press?
No. I learned about it, right before the report was made to Congress.
So you were just given a day notice? So the 12th of June, you learned about it?
I don't remember the day, but I believe
a week before?
No, I believe it was more like the day before.
Okay, so you're the Secretary of the Treasury. The IRS is the biggest bureau in Treasury, and you only learn about this the day before we do. But isn't it true that Treasury was notified by the IRS that these failures existed, and they were notified in April, and then it was Treasury who notified the White House in April that the Lois Lerner emails were gone? But you only learned about this in mid-June.
Yeah, the timeline, as I understand it, is that the lawyers at IRS and Treasury, discussed the matter. They were notified about it.
In April.
In April.
And you didn't know anything about this, right?
And the guidance that was given at that time, I think appropriately.
You didn't know anything about this. Is that your testimony?
The guidance that was given, as I understand.
So you didn't know anything about the emails, all the news about it, and the lawyers know, but Mr. Liu, the poor secretary at Treasury, has no clue what's going on in the agency. Is that fair to say?
Congressman, I'm happy to answer your question if you give me a moment.
If you'd answer the question, I would appreciate it.
Well, you ask the questions, I can answer the question.
Well, you don't answer the question. That's a problem.
The lawyers at Treasury advised the lawyers at IRS, I believe correctly, to make sure they
To not advise you?
Congressman, I'm happy to answer the question if you give me.
You're not answering the question. Here, there's a level of frustration, not just in this committee, not just throughout Congress, but with the American people. The arrogance that the administration has shown, that the IRS has shown, that Treasury has shown with regard to this investigation is unbelievable. And I'd say, why wouldn't you be arrogant? You go, well, listen, we have the presidency, we have the DOJ, we have the FBI. Why not be arrogant? We have the press. No one's going to report on this. We're not going to answer your questions. We're not going to be forthright. We're not going to be honest, because who's going to come after us? I got to tell you, this is a sad disservice to the American people, the way this crisis has been handled. I yield back.
Gentleman yields back. The chair now.
Question if I had been given an opportunity.
I suspect there will be members on this side of the aisle who will be more than happy to accord you more time. Mr. Secretary, the chair now recognizes the gentlelady from Alabama, Ms. Sewell, for 5 minutes.
Mr. Secretary, I'll give you more time. You can use some of my time to answer his question if you'd like to, but I think that it's better served that we talk about what the matter at hand, what you're here for, which is your annual report for FSOC. I'd like to return back to the SIFI designation. In your testimony, you highlight that designation is not the only alternative to address potential risk posed by firms and their activities. What are some of the other policy options FSOC could look at, and how does the FSOC weigh the pros and cons of the different regulatory mechanisms in your toolbox?
Congresswoman, the initial inquiry is whether or not there is systemic risk. And if you don't make the determination of that risk being there, then one option is to do nothing. So there's always the option not to designate. The question then becomes, what is the risk? Where is the risk? Is the risk in a firm? Is it in a product? Is it in a business line? And depending on the answer to the question, it could lead to different actions. So I believe that there's been a kind of oversimplification of the process, which is if you ask the question, then the next step is designation. I actually don't think that's the case. I think that there will be many instances where the right answer is there's not a risk, or the right answer is you don't need to designate the firm. You know, regulators have sufficient authority, and there will be some cases where it will be a product as opposed to a firm that is the issue. So I think we need to like let the process run its course, and that means have full analysis, full awareness of the facts, and not be in a place where we're afraid to ask the question because the answer might be designation. I mean, I think that we have a responsibility, if we're going to have a system that prevents financial crises in the future, to ask those kinds of questions and not prejudge the answers.
I also wanted to know if the FSOC, in its examination of an industry or individual firm, indicates that a particular activity or business practice may cause systemic risk, are companies given an opportunity to address those concerns? One result of additional notification throughout the designation process could be to encourage companies to reduce their own risk. And so would the FSOC consider establishing a process by which a company would be given the opportunity to reduce its own risk profile before designation as a SIFI?
Well, it's not only a question of does the company have the ability to modify in some way its business structure before, but FSOC looks on an annual basis to see whether or not the designations continuing is indicated and what the status is, so companies have the ability afterwards to make changes. You know, I think that as far as the involvement with the company goes, it begins in the middle of the process, not at the beginning of the process, I think for good reasons. We have a lot of information that's available within both the public record and that regulators have, and that you don't need to create a situation where by asking a question, you trigger a public debate at the first instance of asking the question. If it gets serious, there's a huge amount of back and forth between the company and the FSOC staff.
Yeah. I'd like to, my last question is really about cybersecurity. I sit on the House Permanent Select Committee on Intelligence. I think cybersecurity is one of the biggest threats to disruption of the financial industry, along with operational risk that it poses. Wanted to know what the FSOC thought about cybersecurity and what its recommendations have been to its firms.
Cybersecurity is something that I must say I, as Treasury Secretary, as Chair of FSOC, think about constantly. It is one of the kind of new frontiers of risk exposure. I believe that we have, in the financial services sector, made more progress than in some of the other sectors of our economy, but there's still a lot of work to do.
Would you be open to information sharing and reducing the liability so that companies can share?
I think information sharing is very important. There's a big difference between what we see and what companies see. The information needs to flow in both directions. I also think there's a big difference between what large companies have the capacity to do and what smaller businesses have the capacity to do, and where they're working together either directly or through an intermediary, whether it's a utility or a contractor, makes a great deal of sense. We have sought legislation on cybersecurity. The President has issued an executive order that goes as far as he can with his executive authority, but legislation in this area would be very important. I think the industry would be very pleased to see more ability to collaborate.
Thank you, sir.
Time of the gentlelady has expired. The Chair now recognizes the gentleman from Virginia, Mr. Hurt, for 5 minutes.
Thank you, Mr. Chairman. And thank you, Mr. Secretary, for being here and presenting us the FSOC annual report. I do want to ask some questions about that, but I was curious, based on just on a follow-up to Mr. Bacchus's questions about the IRS issue. It seemed to me your response was, well, in 2011 there was a hard drive crash. That's life, and that the IRS really has done everything it can to comply with congressional requests. But I guess my question would be, three of them. One is I mean, do you think that it's important for the IRS, or do you think it's important for Congress to get answers to its questions? And is it important for Congress to be able to see those emails, whether we recover them from IRS or some other agency? Do you think that's important?
Not only do I think it's important, I think that's what the IRS has been trying to do, and Commissioner Koskinen has been working to develop, to assemble the emails to provide them for review of the learner.
All right, well, but in your role as Secretary of the Treasury and ultimately the authority over the IRS, do you believe you have the authority to independently look at what the IRS is doing to make sure that this gets done? And what have you done, what are you going to do to make sure that we pull out all the stops to get these emails?
Yeah, I believe that they are working quite hard. The number of hours and man-years, person-years that have been put into this, the amount of money that is spent is astronomical. They have made an enormous effort. Commissioner Koskinen has testified at length on it. Obviously, it is not a situation that anyone chose to have. There have been a machine failure in 2011, but they've worked as hard as they can to reconstruct, and 70,000 emails, I believe, were turned over for review.
Understood, but obviously it's a very critical time period, and I guess what I would love to hear as a member of Congress who has constituents that are very worked up about this, I would love to know that the Secretary of Treasury is exercising everything within his power to make sure that the IRS is doing that, and it doesn't sound like you've taken any direct role whatsoever, and that concerns me a little bit.
When I became aware of this, what I was told was that the message had been sent from Treasury, I believe appropriately: find out everything you can, find whatever you can, and give a complete report when you have that. That report was completed. I concur with the advice that was given, and if there's any more that can be done, it should be done. But
but you are the doer. I mean, it seems like to me that's a passive.
No, what I can't do is make a hard drive that broke not be broken.
I understand that,
but what they've gone and done is they've looked at all the recipients of emails to pull them out from the recipients' email records. They're doing everything they can, and an enormous amount of information has been provided.
Okay. Thank you. Let me just ask I've only got 2 minutes left, but let me just ask you this question. I represent Virginia's 5th District, a rural district, a lot of main streets, small businesses, family farms, working Virginia families, and access to capital is very important, and community banks and credit unions play a huge role in reaching the people that I represent. In the last 30 years, and I'm sure you know these figures, We've gone from seeing 18,000 community banks that held 40% of bank assets, 18,000 to now today, fewer than 7,000 community banks, 18,000 to 7,000, and assets amounting to 40% to now down to 15%. And I guess my question is a part of the mission of the Financial Stability Oversight Council, your role as chair, does that trend concern you? The idea that we're reducing the number of community banks and the assets that are held there, and does that in and of itself present its own systemic risk when you have the consolidation of these assets and banks the way we've seen over the last 30 years? Does that concern you? And if it does, what do we do about it? What can you do about it? What is the FSOC doing about it?
Congressman, as the different agencies with responsibility for implementing Dodd-Frank have taken action, each and every one has made efforts to try and treat community banks in a way that reflects the importance that they play in our economy and the fact that they're different from large institutions. There's a lot of discussion about it, there's a lot of attention to it, and I believe the rules reflect that. We have a dynamic and changing landscape in the financial services world. We have to keep an eye on what those changes are. I think the community banks play an important part in it, and as we've acted, tried to reflect that.
But does that trend concern you? Where do we well, I'll go back.
Expired.
Thank you.
Gentleman from Illinois, Mr. Foster is recognized.
Thank you. I'd like if we could turn our attention to the upcoming July 20th deadline for the talks with Iran. Which obviously these can succeed, fail, or come to some these talks can come to some, they can succeed, fail, or come to some intermediate result. And what sort of contingency plans are you looking at for the financial part of the sanctions, which may have to be strengthened or weakened or held in place? And secondly, what is the role do you envision for Congress in the overseeing and concurring in any changes to the financial sanctions that may result as a result of these negotiations?
Congressman, we have kept in place the architecture of our Iran sanctions even during the period of negotiation. So the Joint Plan of Action had very narrowly defined, denominated one-time relief, and the rest of the sanctions stay in effect. So since we began the negotiations under the Joint Plan of Action, we've taken over 60 enforcement actions on the underlying sanctions. So we don't have to do anything to put it into place. It remains in place. The question really is what happens if the talks fail? Do we then go for tougher sanctions? We've made it clear that if the talks fail, there would be, I believe, the need to take tougher action on sanctions.
So my question, do you have contingency planning for the possibility of tougher sanctions, possibility of effectively monitoring relaxed sanctions if there's a Well, if in a world where there is an agreement, that's obviously a very different situation, and I'm not going to prejudge what the sanction regime would be after that. We have multiple sanction regimes with Iran. And I can tell you that we will be vigilant about implementing all sanctions that remain in effect after an agreement. If there's an agreement, obviously there will be some change, but we're not announcing in advance what that is. Frankly, we're not at the point yet where we're ready to say that we've seen a basis for making the decision to do that. We're going to have to see Iran making the kinds of concessions that it has to make, which means not having nuclear weapons. Okay, well, let's see. In your report, on the section on data gaps and data quality, which are some of your systemic concerns, you mentioned that they are still unable to effectively monitor securities lending transactions and reinvestment of the cash collateral. So what is the nature of that situation? What action is needed? How worried should we be about that?
Look, I think that there is both an increasing concentration of activity in certain places because we now, for example, in commodities have a registration, so it's transparent what's happening. That puts more transactions in one place. We also have the challenge of communicating amongst systems which are different systems. The reason it was highlighted as a risk there is we do have more work to do on that. It is both a technical challenge, but it's also a question ultimately of the stability of the system. So I think that the observations in the report reflect the fact that we're going to keep working on it.
Well, do you feel like you have all the legislative authority you need in that specific area, or is this something where Congress might have, it's my recollection that during the crisis, something like 40% of AIG's losses were from their securities lending business. So this is not a trivial thing, and it's, despite what was said earlier in this hearing. And so,
well, we obviously have a lot more tools now. I mean, we have a whole set of rules, particularly in the derivatives area, that weren't there before. So we've made a lot of progress. I actually don't know the answer to the question of whether we have all the authority we need, and I would like to follow up as we learn more.
Okay. All right. Well, I will do everyone a favor and yield back early.
I'm sorry?
Yield back.
Gentleman from Illinois yields back the balance of his time. The gentleman from North Carolina, Mr. Pittenger, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Liu, thank you so much for being here today. I am always impressed by your presentations. You're a very eloquent man, even when we don't hear what we'd like to hear. But you have an amazing pedigree. Harvard undergrad, Georgetown University, worked for Speaker of the House Tip O'Neill, Bill Clinton, been in the White House. You're one of the most powerful people in the world today. My background is a little bit different. I grew up in Central Texas. I went to the University of Texas, a fine university. I can't tell you I was one of the better students. I was not. My daddy told me, he said, son, if you want to be smart, you need to hang around a lot of smart people. I built a real estate investment company, and one thing I did was hire a lot of smart people. We had half a dozen attorney groups who worked with us around the country. I'm no longer part of this company. We hired securities attorneys. We hired real estate attorneys. We hired market analysis people. I hired an economist that we kept for 25 years. Resulting from their good work and counsel, kept us out of a lot of trouble. I can say that after 25 years and a couple thousand investors and maybe 60 or 70 partnerships, we never had a failed one. That's the grace of God, but really a lot of good, smart people telling this old boy from Central Texas what he ought to be doing. Today we're looking at the operations of FSOC and what it's doing and its designations, and that's important to a lot of people. It's going to affect a lot of companies and the impact of this country. A lot of families will be affected. Yet when I read some of the input from some of the individuals that would be associated with FSOC and aware of it, I find that they take a different position than the position that you have. I look at Doug Elliott with Brookings, an institution that you've been a part of yourself, who says that heightened prudential standards would cause broad economic harm because insurers are one of the largest providers of long-term investment funds. Limiting the ability of insurers to make long-term investments would be unfortunate, since many commentators have pointed out that the need to increase the supply of such funds, especially with regard to massive investments in U.S. infrastructure that are needed in the years ahead. We look at Roy Woodall, FSOC member, appointed by the President. His comment was that he felt that the FSOC's analysis relied on scenarios antithetical to fundamental and seasoned understanding of the business of insurance and the insurance regulatory environment. Barney Frank, former chairman of this committee, stated that it was not his intent that asset managers be designated for heightened prudential standards or supervision by the Federal Reserve Board because they do not pose a systemic risk. Mr. Liu, my point is that, many of us believe that these designations undermine the market discipline. They allow some companies to be favored, to believe that they are protected from further losses. Some of us see that there's structural flaws in FSOC that allow this to continue. I think the thing that is troubling to me is that you're a bright guy. You're nobody's fool. You didn't get to where you are by just slothing through. But you've got some capable people who understand the business, like the folks who understand my business, that you don't appear to be listening to. And I would hate to think that years ahead you'll look back and say, you know, maybe I should have listened to those people a little bit more. And the concern that I have, and frankly a lot of my constituents have, is the folks in Washington think that they have superior knowledge. They're smarter than everybody else. They've got it all figured out. And I would just commend to you that there's safety and good counsel of wise people who understand the business, like Mr. Woodall. He understands this business. So that's really my comment, and we've got 30 seconds left, and you're welcome to say whatever you like.
Congressman, first, I appreciate the kind personal remarks. The process we go through in FSOC is one that is a level of great detail and great rigor, and all the members of the council have views that are worthy of being heard and considered. There isn't always a unanimous view. I believe the record that was built justified the action taken in the cases where designations were made, but I don't believe it always will. And I just would point out that particularly in the asset management area, no decision to designate has been made yet, so it's premature to know the outcome there.
Gentleman's time has expired.
Thank you.
Gentleman from Michigan, Mr. Kildee, is recognized for 5 minutes.
Thank you, and welcome, Secretary. It's always good to have you here.
Always a pleasure to be here.
I just want to say how much I appreciate your participation, your candor, but also your demeanor in this hearing. And I concur in Mr. Pittenger's commentary. While I might not agree with his conclusions, I concur with his commentary and applaud his demeanor as well. I wish that were more the norm, but your patience and politeness is noted, at least by some of us here. I do agree that you don't necessarily get smarter when you come to Washington. I also have concluded that there's a certain amount of evidence that the trend is in the other direction. But I will say to you, I appreciate, and I'm not speaking of you, I'm talking about some of us on the other side of the dais. I appreciate your politeness. I want to talk to you quickly about two things. One has to do with the Department of Treasury's TARP program. As you're aware, TARP includes a program called the Hardest Hit Fund. Mr. Scott mentioned it. It's intended to assist those communities and homeowners in communities that have been most negatively affected by the financial crisis. Some communities have had a much more difficult time coming out of that crisis, largely because many of the communities that were hit by the crisis had already been hit by a long-term crisis in housing, depressed values, abandonment, etc. So last fall, myself and my staff worked with your team at Treasury. It was specifically former Assistant Secretary Tim Massad, and we were able to secure $100 million to be reallocated from the particular uses that hardest hit allowed to demolition. What I'd like you to consider, and you'll be getting a letter from me later this week on this, is whether there has been any consideration or discussion within Treasury to extend the use, the available uses, eligible uses of hardest hit that could be used for demolition beyond just residential properties, but to look at specific commercial properties in residential communities that have negative externalities and are depressing the value of property. I say that because before I came to Congress, I was involved in doing a lot of work and research and activity in this area, and we were able to conduct a number of studies that measured the impact of demolition on surrounding property values. In Flint, Michigan, my hometown, for example, we took a few $1 million, were able to demolish several hundred homes, and saw surrounding property values have a positive impact. In fact, just several $1 million unlocked the value of local properties to the tune of about $112 million. Changing that value equation obviously is one of the factors that mitigates future abandonment, resulting in foreclosure. Is that something that you might consider at Treasury?
Congressman, the decision on using the hardest hit fund for housing demolition was one of the first issues that I made a decision on.
Well, you made a good decision.
And I believe the analysis was, very solid. That if your goal is to keep houses from going underwater or get them from being underwater to being above water, having abandoned properties on the block was something that had a material impact And since the purpose of those funds is to help homeowners get out from underwater, the relationship was quite direct. I haven't looked at the question of commercial property. I would be happy to look at it, but would have to meet a test that is permissible under the TARP program. And I will just add, I had the pleasure of being in Michigan the day that the demolition began in the Marygrove neighborhood in Detroit.
Right.
And you go block to block in that neighborhood, and you see where abandoned houses have been allowed to sit for a year and where they've been demolished. It has everything to do with stopping the decline and helping the rebirth of a neighborhood. And I think we made the right decision, and I was very pleased to be able to join the mayor there.
Well, I very much appreciate it. It's definitely a direction that makes sense. The application of the funds to commercial properties within neighborhoods, I think, will have as dramatic, if not a more dramatic effect. So I'll be communicating with you on that in the coming weeks. And rather than ask a question, I just want to reiterate on a completely different subject my support for the work that Treasury continues to do in implementing sanctions regarding Iran. As you may be aware, I have a constituent who continues to be held in an Iranian prison. His name is Amir Hikmati, and it has certainly made a difference. The sanctions are what have brought the Iranian government to the negotiating table. I can't prejudge what will happen in the P5+1 or with July 20 soon approaching, but we know we wouldn't be in a position to even have the possibility of an agreement without those sanctions. I appreciate your work on that.
Time of the gentleman has expired. The Chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Secretary. Good afternoon, now that we've passed the noon hour. Just a few days after you testified before this committee in May, Douglas Holtz Eakin, the former director of the Congressional Budget Office, released a study in which he estimated that if the FSOC designates asset managers as SIFIs, investors could see their returns reduced by as much as 25% over the long term. As he puts it, designating asset managers could cost each investor more than $100,000. And while the OFR's asset management study considers far-fetched and remote hypothetical situations, it never considers the cost that will be imposed on investors and on the economy if the FSOC designates asset managers. Nor does it consider whether the benefits of designation outweigh those costs. Shouldn't the FSOC's SIFI designation process consider the cost of designation as well as its benefits?
Congressman, I just want to underscore that no decision has been made on whether to designate the asset managers or not. So the OFR study was one piece of analysis as part of a process.
And should they consider costs of designation?
So the designation process is one that is aimed at determining whether or not there is systemic risk. It is not a cost.
So there's no consideration for the cost that will be imposed.
The statute creates a standard that we use, which is whether or not there is that level of risk that warrants the decision. Obviously, as regulators, if they take responsibility for an area, they then weigh different approaches in terms of how to regulate, and then it's a different issue. But the statute does not actually create a cost-benefit standard. I can't speak to the analysis that you're describing. I've obviously I'm aware of it. I've seen it, but it makes assumptions about actions that have not been taken yet. So I think it's premature for anyone to draw a conclusion.
If we could take a look at the OFR's, the Office of Financial Research's September 2013 report, OFR argues that mutual funds with a floating net asset value are risky because they could create a run on redemptions during a time of stress. Then when I look back to FSOC's attempts to subvert the SEC's jurisdiction over money market funds in 2012, FSOC proposed a floating NAV for money market funds. These two examples seem to be contradictory. Doesn't this just reinforce the reason why regulating this industry should be left to the SEC, who has the needed familiarity and expertise?
Well, the SEC, as I mentioned earlier, is in the process of considering a rulemaking with regard to money market funds, and I certainly hope that they reach a conclusion that's one that provides the kind of oversight of.
Should that be within the discretion of the SEC and not the FSOC?
Well, the FSOC reached a conclusion with the SEC being very much part of the process that this was an important area to address. The FSOC made recommendations. Now the SEC has a rulemaking. And I'll also add that in the process of going through the asset manager review, the SEC is fully a part of that process. They reviewed drafts of the OFR study. They are part of the decision that FSOC will make because the chair is a voting member of FSOC and the staff work on all the preparation to it. So
I'd like to ask a question about getting back to too big to fail and whether it's been ended. The President in this administration has a sad history of overselling its policy objectives and initiatives. They oversold an $800 billion stimulus, saying that it wouldn't cause, or if you passed it, unemployment wouldn't go above 8%. They oversold the Affordable Care Act with the famous, if you like your health care plan, you can keep it. They shockingly oversold, I would say misled, about the impact of a video in Benghazi. They oversold the ability to reset relations with Russia. They oversold the record retrieval capacity of the IRS with the email scandal. They oversold their ability to manage the VA. They oversold the demise of al-Qaeda. Now, as recently as July 2013, you stated, as a matter of law, Dodd-Frank ended the notion that any firm is too big to fail. And you also said if a financial firm fails, the taxpayer will not bear the cost of that failure. Now Secretary Geithner, or today, you said, you seem to backtrack on that. When the chairman asked you if too big to fail has been ended, you testify, we won't know until the next crisis. But that's not how Dodd-Frank was sold to the American people. Secretary Geithner now says that, of course, the too big to fail still exists. Would you agree that the administration oversold the premises of Dodd-Frank?
Mr. Chairman, can I have a few seconds to answer?
A few, brief answer, Mr. Secretary.
Congressman, I tried to address that issue at some length earlier, but I believe we have taken enormous steps to make our financial system more safe and more sound, and to make it so that if a bank fails, a financial institution fails, they will bear that risk themselves. That's what the capital is going to help do. That's what the resolution rules will help do. What I said in the response to the earlier question is a matter of fact. The true proof comes at the time of the next financial crisis. I believe we've taken very dramatic steps and made very dramatic progress.
Time of the gentleman has expired. The chair now recognizes the gentleman from Washington, Mr. Heck.
Thank you, Mr. Chairman. Mr. Secretary, thank you so much for your presence here today. As you know, in 2012, when the Congress reauthorized the extension of the Export-Import Bank, the Secretary of Treasury in your department was directed to enter and pursue negotiations with other major exporting companies with an objective of substantially reducing and with the goal of eliminating a role of export credit authority subsidies of goods sold. I am curious as to whether or not, as a result of that process or any of your other conversations with finance leaders from other countries, has there ever been an indication to you of a willingness on the part of those other countries to, quote, substantially reduce, end quote, their export credit authority?
Congressman, there actually is a working group on export credit subsidies that met at Treasury 2 weeks ago, and there were 15 countries represented at that. I have raised, the issue has come up in my conversations from time to time with other finance ministers, and I've made the same point to them that we have made in public, which is that there has to be a level playing field. It cannot be a question of the United States unilaterally withdrawing from these kinds of programs while other countries stay in, because that would put our firms at a disadvantage. So I think the working group is a good thing, and a level playing field is the goal.
Have any of those countries indicated a willingness to do away with their export credit authorities?
I'm not sure that it's gone that far yet, but that's obviously one end point that would leave a very level playing field. But it can't be that the United States steps back while everybody else is subsidizing their exports.
As you're aware, China is, as we sit and speak, developing a commercial aircraft for sale, the C919. It is my impression that it is being substantially subsidized by China in its development. Would that be your impression as well?
I do understand that there is a Chinese aircraft industry, and I don't know the exact structure of it, but they do have many state-sponsored enterprises.
And they also have a state-sponsored enterprise to develop small aircraft, which are being sold with the assistance of China's Export Credit Authority already. what would your opinion then, Mr. Secretary, be as to whether or not China, with in absolute dollars and as a percentage of GDP, about the largest export credit authority on the face of the planet, what is your opinion about whether or not the Chinese Export Credit Authority would engage in financing of the sale of their C919s, what's there developed? I realize that there's no memo been issued by them, but you're a worldly guy with a strong, firm grasp of how the economy works. Would you fully expect China to provide export credit authority for the sale of their commercial aircraft?
I think we've seen in the commercial aircraft industry worldwide that there is a willingness of governments to provide export support. I have no reason to believe that China would choose not to do that. I don't know of the specific intention. I do think that it is a case where we either all have to agree to not do it, or the United States has to maintain the Export-Import Bank kinds of support so that our industries can compete on a fair basis with other manufacturers who have access to export support programs. There's not a place for the middle ground where we withdraw and others don't.
I don't want to put words in your mouth, to be sure, so let me do a little reflective listening. Here's what I think I heard you say. If our future is that Airbus is provided export credit authority for purchases of financing sales, and the Chinese-made, at some point in the future, C919 aircraft is provided with Chinese export credit authority financing assistance, and airplanes made in the United States of America are not provided with export credit authority financing, that would put us at a material disadvantage to compete in the global market.
Yeah, I think that's correct, and I also think that our administration's support of the Export-Import Bank has been clear. We think it's an important aspect of how not just our aircraft industry, but many large and small U.S. firms can play on a level playing field in a world where other exporters have access to credits. We can discuss a world where there were no such credits, but in a world where others engage in that, we can't unilaterally disarm.
Thank you.
The time of the gentleman has expired. The chair now recognizes the gentleman from New Mexico, Mr. Pierce, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Secretary, for being here today. Mr. Secretary, you had written in your comments on page 2 that we learned from the financial crisis, that is of 2008, that regulators should have asked more, not fewer, questions about the institutions and the activities they oversaw. So why do you think that we weren't asking enough questions going into this 2008 time period?
You know, I can't go back and tell you exactly why different institutions and individuals behaved the way they did, but I think we saw the results, that there was a financial crisis that took everyone by surprise.
I think it wasn't the institutions themselves. It's that regulators should have asked more. Why were the regulators not asking more questions?
Well, there was no regulator that had broad responsibility for looking across the financial horizon and asking about financial stability. Regulators each had their siloed areas of regulatory authority, and in their areas they asked questions the way they had in the past.
There hadn't been anything in the past that had caused people to say, hey, we need to start asking more questions. We ought to work back and forth across these silos. Nothing had come up about that?
In retrospect, there were people saying that there were questions about that needed to be asked, but the system didn't respond. And
when you say the system didn't respond, what does that mean?
Well, I think that in the 90s there was a debate about derivatives. In the early 2000s there was a run-up in the housing market and development of highly leveraged,
what system
risky
was
products.
not responding? That's in other words, what system was not responding?
Well, depending on the issue, it was different regulators. I mean, you had relatively lax regulation in some of the banking regulators. You had
was anyone calling attention to that?
Was anyone calling attention
to
it?
it? Anyone that you in your field of interest, your sphere of interest?
Well, look, I was not in Washington at the time, so I don't want to pretend to having been participating. But the buildup in mortgage credit on riskier and riskier terms was viewed as a narrow housing issue, not as a systemic issue.
Nothing in your experience gave you cause to where you would elevate the concerns.
Well, look, it was not my set of responsibilities at the time, but
well, if I would take a look back at 1994 to 1997 or 8, you were deputy director of OMB, and 1998 you were made the director. And when I take a look at the web page for OMB, it says that it is oversight of agency performance, oversight of all agency performance, measures quality of agency programs, policies, and procedures. Now, it was exactly during that period that long-term capital did almost exactly the same thing. They almost collapsed the world economy according to the leading articles of the day. And under your watch, you had the ability to see that this extremely dangerous thing was occurring in the markets. And what they were doing was ramping up their asset, or they're taking their asset value down as low as 3%. That's exactly what Bear Stearns did 10 years later, down to 3%. And it was one of the original partners at Long-Term Capital who was the head of Bear Stearns. And so we had 10 years to assess. And so the system knew exactly what was going on. You were the one in charge of the OMB. You were the one in charge at the White House. And yet you make the statements here that regulators should have asked more, not fewer questions. You were the one that should have been saying to the regulators, your system's not working. This is a very dangerous thing that went on. And yet now then today we're sitting here, and on page 3 you say, at the time, as the distance in time since the financial crisis grows, we must not forget the financial and emotional pain endured by millions of American families who lost their homes, their retirement savings, their jobs. It would be nice if that same perspective had been kicked out after the long-term capital failure, saying let's not let this go again, but instead 10 years later the same thing happens again. And I find I find your statements to be surprising. I yield back, Mr. Chairman.
Congressman, if I could just respond
Sure,
briefly.
I mean, if I got time, sure.
First of all, when I was at OMB, the Office of Management and Budget has relatively limited insight into independent regulatory agencies, their rules, and the actions they make. They are independent regulators. One of the reasons FSOC was created was to have a place where there was an ability to look across all of the independent regulators and work together. I think FSOC actually is an important solution to that problem.
Again, the warning sign was there. We almost collapsed the world economy. You were the guy in charge of checking the economy.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Sherman, for 5 minutes.
Thank you. Mr. Secretary, last 2 or 3 times you've come here, I've focused your attention on the worldwide unitary system of taxation. Last time you were here, you said your Assistant Secretary for Tax Policy had reviewed that and was anxious to talk to me about it. He hasn't reviewed it. I would hope that you would commit now that your department would devote some serious high-level time to reviewing what would be a system that would increase our tax revenues by over $1 trillion over 10 years, and is the system that has been used by the 50 states to deal with multi-jurisdictional income taxes long before the globalization occurred and we started, and multi-jurisdictional income tax meant international rather than multi-state. Can I get a commitment that you and your department are going to look at this?
Congressman, he has reviewed it. If he hasn't been in touch with you, I'll make sure he gets it.
Oh, no, he was in touch. He basically, we talked for a few minutes, and he had not looked at the issue.
Well, my understanding is that there are people in his office who have looked at it. I'll make sure they contact you.
They're strained on other things. Yeah. I've read Ayn Rand. Ex-Im Bank is not mentioned in any of her books. I would dream of a world in which all competition is fair and as uninfluenced by government as possible. Do you think you could be successful in getting Germany and France and Japan to eliminate their analogs to the Exim Bank if we would just eliminate ours first?
I don't know the answer to that question. Obviously, the engagement that's underway is aimed at trying to answer that question. What I do believe is that it would be wrong for us to unilaterally withdraw from the Export-Import Bank while other countries are providing export subsidies, putting our manufacturers and exporters at a disadvantage. There needs to be a level playing field.
It's strange because I'm in the Foreign Affairs Committee, where sometimes members of our party are accused of being in favor of unilateral disarmament, and then I come here and it's folks on the other side in favor of, or at least some, in favor of unilateral disarmament.
And I don't disagree with the notion that it would be a good thing if there were no export subsidies. The two positions are not inconsistent.
Right. But wouldn't it, if we eliminated the Exim Bank, wouldn't our foreign trading partners have absolutely no incentive to eliminate theirs?
I think if we did it on a unilateral basis, yes. It was part of a negotiation,
right.
Obviously very different.
That would be like doing missile control with the Soviet Union by eliminating all our missiles and then going to the missile control.
Not sure I'd want to compare the stakes, but it's, I understand the analogy.
Okay. You've got to define SIFIs. The tendency is to define SIFIs based on the size of their assets. I want to urge you to do instead to look at the size of their liabilities. What causes a SIFI to bring down the entire economy is that people were expecting that they would meet their obligations and they're unable to do so. For example, if you had a company with a great name but modest assets that went out and incurred $1 trillion of contingent liabilities by writing a bunch of credit default swaps, that entity would be a SIFI, assuming defaulting on $1 trillion of credit default swaps would bring down the economy. Maybe the number would be bigger, regardless of the size of its assets. As a matter of fact, the smaller its assets, the worse that situation we're in if they're engaging in more than $1 trillion of credit default swaps. With that in mind, as to mutual funds, they don't have liabilities except if they're leveraged, except for one thing, and that is they have the contingent liability that if the custodian function is not handled correctly and you open the safe and there's nothing there, then they have a liability. So I would hope that where you're dealing with an unleveraged mutual fund with extremely strong custodian functions, that you would not be designating that as a SIFI. I don't know if you've got a comment.
Well, as I've said a number of times this morning and afternoon, that we have not made a decision yet, but we definitely understand that there are different kinds of assets in in asset management funds, custodial funds. Mm-hmm. I understand the important difference between leveraged and unleveraged funds. Mm-hmm. We will complete this process and reach a determination as to whether or not there's a basis for designation. But asking the question does not mean we decided to designate.
Okay. And likewise, insurance companies seem to be well regulated. It's when you let the unregulated portion of AIG write credit default swaps that you've got a SIFI problem. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Illinois, Mr. Holtgren, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Secretary Liu, for being here. I want to follow up on how we can work together in a bipartisan and constructive manner, as Subcommittee Chairman McHenry had questioned a few minutes ago. As he noted, we've passed a couple of dozen bills by supermajorities out of this committee, including many by voice vote, and many of those have passed the House as well, that made sensible reforms to Dodd-Frank. Notably, even former Fed Chairman Ben Bernanke, in his last appearance here, when asked where Congress should focus and where the Fed would be interested in engaging, he stressed a couple different things. One, he stressed swaps push-out, which creates more systemic risk and impacts end users' ability to hedge. Another one he mentioned was end-user margin, which Congress never intended and where regulators need clarity. And also third, he said regulatory relief for banks, especially smaller financial institutions.